we have capital adequacy standards, как сказать, норматив достаточности, так называемый. I can send full and detailed response by email. Sorry.
Yeah, I believe we will have our questions written and forwarded to the Secretariat, and then he will offer response via email. I hope that is workable. Thank you very much. I will return it to you to now give your parting shot, if any. All right, let's give him a big round of applause, ladies and gentlemen. It was a wonderful, wonderful presentation. We sincerely appreciate that. Thank you. In case of any questions, the email, please project back the email address that we have. There was an email address there. Just project back what was the last slide. Yes, this is the email address. In case you have any questions or you want an interaction, please feel free to write an email to that, and it will be appropriately responded in due course. Thank you so much for that. All right, and I was just confirming that, as usual, I promised yesterday that our speakers have the benefit of a gift that is not so small. As I said, we are not going to be very demure. We have quality gifts for our quality guests. So, I will invite back Bwana Askar and Bwana Tiberius, please come over and present this one. Yes, please. Where would you want to have it from, photo team? On top here, okay? Yes. We will present this gift from us to you. As you go back to Kazakhstan, tell them Kenyan people are so very nice, and we have been honored to have you with us at the Policyholders Compensation Fund at 20. Awesome, awesome. Wow. Yes, the king of the jungle. We clearly say that you are one of the kings of the jungle when it comes to the field of insurance and actuarial services that you have always delivered and excelled at. Thank you once again. We appreciate and say thank you so very much. Great smiles, by the way. Wonderful. Thank you very much. Ladies and gentlemen, another round of applause one more time. Thank you so much. Now, I have 3 requests, and I hope we will honor them in succession. Request number 1, I have noted we have so many gaps between the second row and the final row there. Now, I have this request. Is it possible that we occupy the first 3 rows? It is also good for our photography, if you don't mind. The first 3 rows means that we can all, beyond this line, is that orange or red? I'm trying to, that is orange, eh? No, the one behind you. It's orange, eh? So that line. Thank you so much. Oh, you guys are amazing. You people are good. The third row, please make it 3. If you can come over, we don't mind that you had already consumed the sweets or the water. We just mind you being closer to us so that we feel warm together. Just the 3 rows. Thank you. Don't make a 4th one. I have requested for 3. You know, it's nice when you obey fully. Thank you. You're very kind. You're very kind. Yeah, 3 rows is good. I see very well. Oh, amazing. Now we look better. Photography team, see, we look better this way. That's beautiful. Thank you so much. Thank you. Thank you. Thank you. Now, number 2, I want to confirm that our party is still on this evening from 6 p.m. at the Carnival Simba Salon. We will be inviting you over to celebrate with us as we conclude this conference and officially say PCF at 20 has been a mega success. We are doing a setup for the virtual presentation that is coming up shortly. We are having our presenter all the way from Malaysia. Malaysia. Yes, all the way from Malaysia. He will be coming through to give us the presentation. The proper introduction will be given in due course. Team, once you're done with the setup, you can confirm with me so that we are able to proceed. All right. All right. Right. Okay. Even as we do so, I remember yesterday I made an effort to get some dancers, which was quite unsuccessful because people were not honest when they were caught. Some turned their faces so angrily that I got scared to even follow up. I remember one looked at the other and said, "Do you know me?" And then the other one was like, "It's a game." Okay, so I am in this effort to now. Yes, I see. Okay, okay. So this is how you guys look on TV. Okay, interesting. Good. As we do the setup, let's try and get dancers for our dinner. And we're going to use the same methodology, but this time I'm not going to use the word love. I'm going to use the word celebrate. Okay? All right. Right hand, all fingers left except for this one. All right. Then the left hand on your neighbor's raised finger, up or to Jew. Yes, on top there. Good, good, good. Right hand this, left hand on your neighbor's raised finger. Now we have a good network. I can see a full line of people. Yes. Now, people, remember the word is celebrate or celebration or anything that looks like celebrate. Are we good up to that point? That will be easier for you to get, right? So, remember, if I say the word celebrate, please grab your neighbor's finger, but ensure that yours is not caught. Confirm you can grab. Let's try. Good, 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 good. All right. Now, good. Present them nicely now. Flat hand. Let's see. It is important to always look at life in a way that is worth remembering. But as we remember all the beautiful aspects of life, we need to remain in a state of happiness, because happiness is viral and infectious. Happiness is beautiful and happiness is worth notably enjoying. So as you celebrate, everyone, how many people have been caught? Honestly. I have 1, 2, 3, 4. Those are our 4. Yes, 4 of you. You are our dancers in the evening. You are our official dancers in the evening. Are we good? Yes. We are in another session. We will add 5 more, and actually 6 more, so that you'll have a troop of 10 and give us a dance of our lifetime as we celebrate the African-themed dinner this evening at Carnival Simba Salon. And what I can tell you about the session, I had the privilege of passing by in the morning, just passing by, because I stay in that rich neighborhood of Carnival. But do I say? So as I was passing by and just checking the setup, I tell you, those guys are really prepared for us, and we are going to have a time of our life this evening. Remember, our theme is African. And for those who are already in their African wear, it is good. because you can straight head to the party after this. But for those who are still feeling African at heart with their suits, I hope a miracle happens and you'll have your African wear later. But most important is your presence, because we want to celebrate together. Now, I will hand it over to Deputy Director Noel, who is also the chair of this inaugural Africa Insurance.
Good morning, delegates. Good morning once again. I am honored this morning to introduce to you an extraordinary lady who is not only a leader, but whose work speaks volumes and whose presence elevates the conversation we are about to have today. She is Ms. Afiza Abdullah, Executive Vice President of PIDM Malaysia. Ms. Afiza Abdullah is the Executive Vice President responsible for the overall management of PIDM member institutions, resolution plans, as well as the functions related to various aspects of PIDM intervention and resolution, crisis management, macro surveillance, and policy. She also oversees the assessment, planning, liquidation, and undertaking of timely and effective reimbursement of protected benefits and insured deposits of PIDM member institutions. Madam Afiza joined PIDM in 2011 as Deputy General Manager, Policy and International Division, and was subsequently appointed as General Manager, Policy and International Division in 2016. With a vast experience in policy making on matters relating to deposit insurance, insurance guarantee schemes and resolution, Madam Afiza is active in various discussions at the international fora and a well sought after speaker. And that's why we have today, and we are privileged to have her speak in this conference. In addition to her current responsibilities at PIDM, she is currently the Vice Chairperson of the Asia Pacific Regional Committee of the International Association of Deposit Insurers, IADI, and just completed a chairmanship of the IADI Resolution Working Group that established the Resolution Technical Committee at IADI. She has also previously served as the chair of the International Forum for Insurance Guarantee Schemes, IFIX, in 2022, and the vice chair of IFIX in 2023. Prior to joining PIDM, Afiza had over 9 years of extensive regulatory experience with Bank Negara Malaysia, and had been involved in, among others, prudential policy formulation for insurance and banking sectors, and the modernization of the Central Bank Act 2009, as well as the regulatory laws. She was a core team member in the development of the Bank Negara Malaysia Financial Blueprint. She began a career in an audit firm in London, United Kingdom, and joined a local investment bank upon a return to Malaysia before joining Bank Negara Malaysia. Kindly let's put our hands together as we welcome Madam Afiza Abdullah. I can hear you, Madam Afiza. Go ahead.
Okay, I'll start then. Yeah, thank you very much for that lovely introduction, Noel, and everyone. I'm pleased to be here to be addressing you. I'm sorry I couldn't be there with you physically. There are many familiar faces, even when I'm looking through my tiny camera here. Is there feedback? Are you guys okay? So, okay, I will continue. Yeah, okay. Okay, lovely. Thank you. So my presentation today will look at our experience, the Malaysian experience in introducing our insurance guarantee scheme, as we call it. We call it TIPS, Takaful and Insurance Benefits Protection System, and how we have collaborated with other financial safety nets. So I will cover that in my presentation. So let's start. Next slide, please. Okay, so PIDM is a statutory body. What that means is that we have an act by the Parliament backing our establishment, and we were established in September 2005 under our act called the Malaysia Deposit Insurance Corporation Act. And we started off as a deposit insurer. And we have gotten our insurance guarantee scheme mandate in 2011. So we are a member of the Malaysian Financial Safety Net players, which consists of the Ministry of Finance and Bank Negara Malaysia. Bank Negara Malaysia is our central bank as well as our prudential supervisor. So in fulfilling our mandate, we actually have two separate mandates. One is as the deposit insurer or the insurance guarantee. We also have the resolution authority mandate. So this is depicted in the slides in the yellow boxes on top. So our mandate include the following. One, we would be protecting the depositors and takaful and insurance benefit owners. And if you're not familiar with the term takaful is just a Islamic insurance, so we call it takaful. Secondly, we want to create awareness on the protection systems so that we can enhance trust in the financial system of Malaysia. Next, we provide incentives for our member institutions to remain safe, sound, and resolvable. I'll talk a little bit on how we do this later. Number 4, we ensure our member institutions can be resolved effectively. So this is where our resolution authority or mandate comes in. And finally, we would enhance ourselves and together with the other financial safety net players for crisis. We cover both member banks and insurer members, we call it. So we are an integrated protection system. And as I mentioned, we cover depositors for member banks and takaful and insurance policy owners for insurer members. By doing this, we hope to enhance public confidence in the Malaysian financial system, as well as promote financial system stability. So this is our mandate. Next slide. So firstly, I will talk about our insurance guarantee scheme or the protection part of our mandate. So in coming up with the protection system, which we call TIPS for insurance, we were guided by 5 guiding principles. So this might be beneficial for some of you who's looking to establish an insurance guarantee scheme. So we're guided by these 5 guiding principles, which are the following. The first one, we want to give an appropriate level of coverage. So I think the question that we have received earlier from the floor touched upon moral hazard. So that is high on our consideration. So there has to be a healthy balance between moral hazard and also long-term efficiency and competitiveness for the industry. So the level of coverage has to balance this. Secondly, we want also a reasonable balance in the protection as well as minimizing unnecessary burden to the industry. So it cannot be 100% foolproof the cost is so high that it is a burden to the industry and it can't grow. So we don't want that. So we need to have that balance as well. Thirdly, we want to have an equitable coverage as much as possible for conventional, which is a normal industry, as well as the Islamic side of the sector, because we have both non-Islamic as well as Islamic insurance members. So we want them to be equitable. It might not always be equal, but on equitable principles. Fourthly, if you are an Islamic entity, we want to make sure that the Sharia compliance is adhered to. So Sharia, if you're not familiar with that term, it just means the jurisprudence. So it's the Islamic jurisprudence. So we follow the Islamic determinations and jurisprudence on all Islamic related or takaful matters. And finally, we want to ensure that the needs and requirements of our local environment and economic developments are met by our key design features. So this is, I think, when you're looking to establish an insurance guarantee schemes, 1, 2, 3, 4, I think is given. And 3 and 4 is specifically if you have an insurance or Sharia or Islamic members. But number 5 is where you should really weigh in on the local context and what phase of development your financial system is at the moment, because this is the distinguishing feature for every one of us. So say, for example, if you compare with Alistair's Canadian system, you would find, and I can see Alistair's there, so hi Alistair, you will find there are differences, and this is really because we are at different stages in our financial sector or development, and also the context of our industries are different. And we follow these 5 guiding principles so that we can achieve our insurance guarantee scheme's objectives. And this is really what we say for our public interest. So this is our public interest policy objectives. And these are the following. 1, we want to provide a financial safety net for our financial consumers for the insurance and takaful. I mentioned PIDM is an integrated agency whereby we also protect the banking depositors. So in this case, we want to have that level playing field between the insurance and the banking industry as well. And as you know, in Malaysia, for insurance, there's general and life insurance sector, where we also try to level this playing field between these two sectors, even though they are different. So we are all housed under one authority, which is PIDM. We also want to accord similar protection for all consumers in the insurance industry, be it Islamic or conventional, life or general, as an equitable sort of principles. Thirdly, we want to promote public confidence and contribute to the growth of the insurance industry. So with the protection provided by PIDM, the confidence to actually buy insurance product would be there, and we hope to increase insurance penetration rate in the Malaysian financial system. Fourthly, we want to complement the supervisor's efforts to promote sound risk management of insurers. So I alluded earlier about we giving incentives for safety and soundness, and I'll talk a little bit later about how in the last few years we have even contemplated or included in our system giving incentives for being resolvable. And finally, we want to have explicit intervention and resolution powers for prompt and orderly resolution, thereby preserving financial system stability. And this is because we do have both objectives of being the protection system provider, as well as the resolution authority. Next slide. Okay, so this, in a nutshell, where our journey has been. So as I mentioned, we started in actually December 2010 or 31st December 2010, which is a cheating way of saying, it's the 1st Jan 2011, which we started. And initially on the onset, for first few years, we were focusing really on our protection system, which we call TIPS. We were actually establishing all the key features and the protection feature, for example, the limits, protection limits of up to 500,000 on all or most of our insurance benefits, be it general or life. And we have also looked at what category of benefits that we want to protect. So those we actually target or complete that earlier on in our establishment, in the earlier parts of our establishment. And coming into the protection system, this is again where we differ from, for example, in Canada or in some of other, in Germany or some other places, is that we are an ex ante funding system, which means that we connect when there's no failure. So everyone will contribute to the fund, and when there is a failure, the monies will be used, or the funds will be used, the collected funds will be used to actually mitigate or address the failure. And in the first 5 years of our establishment, we were sure that we are going to go into a differential levy system, which means that we want to charge our member institutions based on the risk that they pose on our funds. This is primarily tagged in the earlier years to the PD, or the probability of default. So if you are highly risky from a supervisory rating assessment results, we will charge you more. That's all what it means. But initially, when we first started, we also started with a flat rate system. Because to be able to come up with a differential levy system, you must have some sort of a scoring mechanism for the scores that you get on the dimensions that you choose. So without knowing what is acceptable at that moment, we started out with a flat rate system, and then we come up with that score ranges so that we can actually give appropriate score to incentivize them to improve their scores over time. And with that, there's a question about how long are you going to collect this? Are you going to collect this forever? Because remember, we are an ex ante funding system, and hence we established the target fund. So this is where we give a range whereby for given simulated failures that we target, how much fund would we need to actually resolve those failures. So in the first 5 years, we were focusing all our efforts to actually come out with all these frameworks, or putting all this framework in place. And of course, one of the highlights of the first 5 years of our journey was that we were one of the founding members of IFIX, and we established this, and I'm very pleased that it is still going very strong. The objective was it's exactly like this, to share our journey, to celebrate successes, as well as to share with you our pain points. And if you have questions later about our pain points, I can actually share some of that with you also. So that was the first 5 years of our establishment. The next stage was really going deep into granularity. So when we first started, it was just to keep to establish the system, so that we know what we are covering, how much we are charging the industry, and how are we going to collect and fund our failures. The next, say, 3 years after that, 2016 to 2018, we remember I told you we started with a differential levy system after flat rate. We extended that to our Takaful operators. So of course we started with the conventional players, and the next step was to extend that to our takaful operators. And you might ask me, why is there that separation? It is because for takaful operators, the dimensions or the ratios are different in terms of how you see their probability of default, or the criteria in which we want to assess whether they are safe and sound. And this was completed in 2016, and with that we made a revision of a levy rate for actually our general insurance members. So why was this done in 2016 was because, unlike the life counterparts, our general insurance fund was in the money, we call it, because the last failure that Malaysia had on insurance industry was a motor player. So it's a general insurance failure way back in the 1990s. So after that failure, there has been a collection on to recoup the funds that was used to resolve that particular failure, and the collection continued for years. So when PIDM established formally the fund for resolving general insurance failures, we were already we have some funds already collected, and hence by 2016 we have already actually met the lower parts of our target fund, for example. So there is a need to revise that minimum levy amount for general insurance. And then from 2018 onwards, maybe we were focusing a lot more on our resolution mandate. So we had initial participation in crisis management group for the bigger guys, for example, Prudential and some of the bigger GSIs. At that point, there was a GSI, so they established a CMG, and we were already part of that initial crisis management groups. And we also started to have simulation exercises at the domestic, at Malaysia level, to test our resolution readiness for solving or resolving insurer member. So this was during our developmental as well as our expansionary phase, where we were focusing a lot more on resolution efforts or framework. And 2019 onwards to recent, maybe 2023, we focus more on updating our protection. So we had a holistic or really comprehensive review of our protection system, and we want to incentivize or look at not only the probability of default, but also want to incorporate the resolution and resolvability in how we incentivize the insurer member. And secondly, we look at what will be the presumptive path or the approach to resolution for insurance. So we have like a internal paper to look at what will be the presumptive path for general insurance failure, as well as a life insurance failure, and of course the idiosyncrasies to dealing with resolving takaful institutions, for example. So in 2019, we have landed on continuity of coverage as our resolution objective, and this has been our objective and for resolving our member institutions. And recently, like many of us in the room, I think we had to deal with a contemporary issue of IFRS 17, where it came into our shores, and our member institutions have to adopt them, and the new standard, where it's a game changer, because they remember the criteria we use for assessing their ratios and all that would need to be changed. So that means that there would be, we are looking at changing how we're going to charge them with new criteria and ratios using the IFRS dimensions, as well as the target fund that has to be reviewed as well, and also looking at how the industry change with IFRS 17 and how the new products offering and all that would change. So there's a new wave of review that needs to be done post IFRS 17 for us. And that has been our journey. And I like to say that, we are there, but we're not. So from 24 and beyond, we're looking into the future. We're looking at many other enhancements. So for us, with the changes, there is the enhancement to our intervention risk rating. So this is just internally how we assess our member institutions, and because at this only we don't only look at the ratios, we see how they are rated, and this rating will inform how what actions we take on them. So we call this assessment intervention risk rating assessment, and we have updated this recently, and now we have incorporated use of resolution or resolvability criteria into this assessment. Moving forward as well, we would be looking at resolution readiness by our institutions, which does not, I know what you're thinking, it's not really resolution planning for us, because in Malaysia, we don't really have resolution planning mandate yet for our insurer members, but we look at what would be the industry impediments for resolution. So in knowing this industry impediments, we provide incentives for them to enhance their readiness or minimize the resolution impediments at industry level. And how we do this, we actually tie it to our DLS to include the fact that they are minimizing their impediments into our charging system. So if you manage to minimize your barrier to resolution, you will get some discounts or incentives in terms of the levy that you pay to PIDM. So along all this journey, we collaborate, or we work very closely with our prudential supervisors and also the Ministry of Finance, because at every point, the interaction with the supervisors are really critical. For example, in our DLS assessment, there are two parts. One is a supervisory rating, whereby they would we would use the supervisory rating, rely on Bank Negara supervisory rating or the prudential supervisors supervisory rating. But we also look at resolvability impediments to give some incentives for that. So if we can go into that in a little bit more detail, or if you like, I can pause here if you have critical questions that I can address now, or burning questions that you before I go into the collaboration that we have with our safety net players. Okay.
We can proceed.
Okay. Sure. So I'm going into the less technical areas now. I've covered all the framework and the technical parts of my presentation. If you do have a question, I do have a more detailed slides that I can go into, but let's save that if you have quick questions later. I want to go into this collaboration. So as you know, apart from all the framework, what actually make or break your protection, either your protection system or your resolution efforts, is actually collaboration with your primary supervisor, or in our case is Bank Negara, which is the central bank, and the prudential supervisor. So we coming into the scene, because of our experience with deposit insurance, we know that it's critical to build this relationship and to be able to have a very open and transparent sort of relationship with the prudential supervisor. So for us, we did this. It's probably the first thing we did. So we know your key stakeholders. So in our case is the Bank Negara, or the primary supervisor and regulator for our insurance member. So the first thing we did was to get a strategic alliance agreement. So what this means is that in that sort of agreement, we agree in principle. So in the main body, because things are constantly changing and sometimes it changes very fast. So in the body of the agreement, we set out the principles of this sharing. So it's the spirit of why we should work together. So those are there. So even though the appendices might be obsolete, but the spirit of why we need to be working together and the need to be transparent and have this kind of good faith trust between the resolution authority and the supervisory authorities are actually documented in that document for us. So we are very lucky to have a very cooperative prudential supervisor, and there is that candid sharing or transparent sharing. Not to say that we don't have our disagreements. That's not what I'm saying. But and it's not always harmonious and cordial and hee hee ha ha. But we sort of get to a landing where at the end of the day, we can annoy each other, but at the end of the day, the spirit of why we are cooperating is for the financial system stability. So that is documented. And in this strategic alliance agreement, we articulate areas of sharing and information sharing, risk monitoring, early interventions, coordination for early intervention if there's any, and coordination for resolution actions were all documented in there. And when we first started, Bank Negara was also kind enough to provide some capacity or sharing of resources sort of arrangements. So and in the appendices, of course, over time, the document becomes larger and larger. So when we first started, for example, for the bank side, we didn't have resolution planning. So now we have resolution planning. So we have to keep updating the appendices that attach to this agreement. So I don't know how to focus if you're looking to establish this. This is, I think, your key focus that you need to get this, part of your main things to do, because only if there is that working or good working arrangements with the primary supervisors, only then I believe that resolution authority can be effective. And to show to you that how Bank Negara is a very sporting and very wise partner of ours, Bank Negara has a Financial Stability Executive Committee, which contemplates not just our member institutions, but maybe NBFIs, non-bank financial institutions, outside of maybe shadow banking and all that. Our CEO actually sits as a member of Bank Negara Financial Stability Executive Committee. So that is the kind of relationship we have with Bank Negara. And I forgot to mention that the governor, as well as the Secretary General of Treasury, actually are also our board members, PIDM board members. So, secondly, what we have is PIDM, tri-party sort of coordination or crisis management arrangements between PIDM, Bank Negara, and MOF, our Ministry of Finance. So where we actually we did interagency or joint simulations where 3 agencies sit down and actually go through a simulation test on a failure, where we test what we have done in the past. We have tested communications protocols between the 3 agencies, and we are also in the midst of having protocols or playbooks, communications and governance and stuff like that, or binder for interaction between these 3 agencies. And the third one, I think, which is also critical, is funding arrangements. So whatever you collect as part of your insurance guarantee scheme would not be enough to cover 100% of all liabilities your industry collects. So that goes without saying. If you collect 100%, we go back to the moral hazard issue that we spoke about earlier. So funding arrangement should be enough to cover a reasonable amount that you wish to cover. For us, maybe 2 or 3 mid-sized failures, for example. But that is also contextual in your case. You have to look at how your insurer members are interlinked. What will be their transmission channels for contagion, and then you can come up with that sort of simulation, what you need when there is one failure. And at the end of the day, there should be someone providing the backstop funding. So for us, that provider of that backstop funding, which is, it's embedded or explicit in our law, is the Ministry of Finance. So they are the backstop provider of funds. And so we rely on them for funding in the event that we need to access extra or additional funding. And in these arrangements, you will appreciate why there is a need for that kind of good sort of relationship between the 3 agencies. So you can't really operate in a vacuum in as a resolution authority or as a deposit insurer. Finally, we also look at cross-border or regional coordination. I mentioned CMGs, and there were really established CMGs, but there are also newer CMGs that we're a part of, which are maybe more strong regionally and not on the global level. So we are focusing on all of these areas for regional coordination. We are also having some bilateral MOUs, especially in jurisdictions where our members operate and they operate in a more significant or material manner. So is this the last slide? Or yeah, so okay. And maybe so this is what I really want to focus on today, because I think you have heard about the framework, and the time given is not enough for me to go into some of these technical frameworks, but if you have questions, I will gladly answer them. So I will finish with the next slide. I think I have one more slide. Yeah, so I just want to talk about the contemporary things that we're currently doing, which is with the implementation of IFRS 17. We needed to change a few things, and I'm sure you are also looking at some of these things in your jurisdictions. So, as you know, because of the fundamental change in the approach, the accounting approach, the new measurement of insurance liabilities, and transparency and disclosure, we need to make some amendments on our part. So firstly, the intervention and resolution assessment and monitoring has to be adapted. Because of the new measures, we need to be able to, for example, as a very simple example, last time, with this kind of liability, you are rated in a certain way. With 17, just by changing the accounting standard, your liability has ballooned to one other number. So it cannot be that overnight your riskiness, if you have a measure of liability as a gauge for your riskiness, increase overnight just because of accounting change. So those kinds of adaptations and narrative has to be actually recalibrated in all of our framework for assessment and monitoring. Secondly, target fund. For us, our denominator or the proxy for our exposure is actually liability. As I mentioned just now, liability has increased overnight because of new liability measure in the form of CSM or whatever. You guys know more better than me. So does that mean that the by tomorrow your target fund has the target fund has grown by whatever percentage? So we need to actually look at our target fund, recalibrate that as well. And finally, our levy assessment. In the past, we have a certain measure. For example, we were looking at premium, for example, as a gauge for growth. And as you know, under 17, premium is no longer a line item under 17. So you can't find it anymore in the financial statement. So does it mean that they don't have to pay a levy? It doesn't mean that, right? So we have to change that to actually to suit the new accounting standard. We know we have to do all of these changes, but as you know, we are just starting with 17. So there is that stabilization period where numbers may not be as accurate as they would be under IFRS 4, for example, who's been there for a while. So, and also there isn't sufficient data for back testing. So we are currently, we have to actually come up with some transitional arrangements or measures to actually look at what do we do in the interim when data is really in the process of hardening. And with this, our transitional arrangement includes having or relying or anchoring on Bank Negara supervisory rating for our proxy for DLS or our levy charging, and also we changed the proxy for PIDM's exposure at resolution to align with 17 requirements. So I hope that doesn't give justice to the complex nature of what we are currently, all of you are currently also facing, I believe. But I hope to give you just a flavor of what we are currently doing now, even though, for example, we have stabilized our protection system. We have somewhat looked at how we're going to resolve, or we have come up with a presumptive approach for resolution, but there's no rest for a resolution authority. I think now we have to look and review this in accordance to the changes that we are currently facing. So I think I have earned my coffee, Moses. I don't know, but I will pause here and take some of your questions if you have any. Thank you very much for your attention.
Thank you very much for that elaborate presentation. And I'm going to now bring the audience to give the questions. Will you want to answer them one at
We can do whatever you like. I prefer maybe 1-to-1 maybe,
That will be
so that, yeah, thanks.
awesome. Let's get to see how many have questions. 1, 2, 3, 4, 5. I have the 5. So we will have 5 questions, and we're starting with the first one.
Hi, Afiza, Alistair here, and an absolute pleasure to see you, and very sorry that I'm not seeing you in person here in Nairobi. I think in the discussion we had with this group yesterday, there was a lot of conversation about coverage levels. And here in Kenya, the PCF team have established 250,000 shillings. You started with 500,000 ringgits, which is more than 15 million Kenyan shillings. So it looks like Malaysia started with a much higher level of protection right at the start. Could you talk a little bit about how you set that number, especially when you had presumably at the start no fund at all? And how did you think your way through that decision might be useful for all the other countries here who are thinking about going from nothing to something, and how do they think about the starting level of coverage?
Thank you, Alistair. I was going to say, you all can ask questions. Alistair can answer all of your questions, but he got the first question. So here we go. So this is my more detailed slides on coverage. As you rightly mentioned, we started out with 500,000. So I'll just explain to you the context first. So remember I told you we started with deposit insurance. We didn't have any protection for IGS. But what happens in 2008, what happened to all of us was the global financial crisis. So during the global financial crisis, Hong Kong was establishing a blanket guarantee for their bank deposit. So they call us, they call Singapore and say that, oh, we are financial centers in the region, so we have to, together, we have to actually offer blanket guarantee for our financial consumers. So that's what we did together with Singapore and Hong Kong. We had a blanket guarantee. And our blanket guarantee does not only cover bank deposits, because we didn't want the bank deposits to fly, the flight from insurance into bank deposits if we only have blanket guarantee for banks. So what we did was we cover all financial consumers, be it investment banks, insurance industry, we have development financial systems as well as banks. So we covered everything, everyone under the blanket guarantee. So when you say people are moving from zero to hero, for us, we were moving from hero because at one point we had 100% guarantee. We had blanket guarantee in 2008. So as you would know, the best practice for a blanket guarantee is as soon as you announce a blanket guarantee for moral hazard or market discipline purposes, we have to announce when are we exiting the blanket guarantee. So we announce we would exit the blanket guarantee in 2 years, hence the 31st December 2010, whereby with the exit, of course, when people have the full guarantee, they wouldn't want to accept anything less. So we say with the exit of the blanket guarantee, we would establish the insurance guarantee scheme because the deposit insurance protection system was already established. So so that's why I mentioned the context in your jurisdiction matter. In our case, we were going from 100% protection under the blanket guarantee, and we know we have to come up with somewhere not too low, Alistair. So the first thing we did was through Bank Negara's help, actually we come up with the average sum assured of the industry for all of the insurer members. So we found that 500,000 was sufficient to cover actually in total 96% of both general and life. But of course, you have a more granular detail here: 99 for family takaful and general, and family and life, and 96 for general and takaful and general insurance. But overall, it's almost like 97% if our protection level is at 500,000. So then we say that that is good enough to provide that assurance to our policyholders. So that was our story, Alistair. I hope that helps.
Thank you very much. Because of the limitation of time, I will request that we have the questions and responses as brief as possible. Thank you.
I'm sorry. So much to tell.
Okay, my name is Leah from Insurance Regulatory Authority. I have two questions. I would like to know the early interventions for companies in distress. You said that you carry out interventions. I'd like to know which ones. And then you also said that you give incentives to companies so that they remain safe and sound. I would like to know which are those incentives that you do give.
Thank you for that lovely question. I'll try to answer that concisely. So in our early intervention, if you look at the slide that is being flashed now, our early intervention trigger takes into account some of the ratios that, the normal ones like capital, liquidity ratio, business growth, and stuff like that, or persistency and all that. So if it hits some of these criteria, we have the power under PIDM Act to actually carry out an examination on the company. So that is our early intervention powers. And with that, we also can prep for either reimbursement or we can do a playbook. What playbook means is just planning for its intervention and resolution. So that's our early intervention framework, trigger framework. For your second question on incentives, so our incentive system, can we go to a DLS slide? So our how we charge the industry. Okay, thank you. So how we charge the industry is using this. So we charge the industry by having quantitative. We have 60% quantitative criteria, and these are the criteria: capital buffer and operational sustainability measures, and also qualitative criteria. So under qualitative criteria, I mentioned that you have the Bank Negara or the supervisory rating, as well as other information. Other information, or if they've been submitting bad data, you can actually penalize them here. Or subsequent adverse developments, you can actually penalize them here. But under the capital and operational sustainability measure, we give incentives for some of these financial ratios that measure assets, business growth, business profile, and profitability. So this is how we incentivize them to improve on these financial ratios, so that with the improvement of these ratios, they would be charged lower levy. So that's what we mean by incentivizing our member institutions.
Thank you very much for that. We have our third question coming through.
Thank you. My name is Caleb Ngala. I'm from organization called Light of Hope Away from Home. Our work is much on advocacy, on policy making. And I just have a quick question to you. Thank you for a wonderful presentation. On matters policy, the insurance industry faces several key challenges, including technology disruption, cybersecurity threats, data privacy concern, regulation compliance, and impact on climate change and natural disaster. Do you have a policy that is protecting both parties, the service providers and the people who seek service? Because without a policy, whatever maybe you might be presenting might be just a document put somewhere, but do we have a guiding policy that can give life to what you have presented?
Maybe I'm not very clear on the question. Do you want to repeat the question, or Noel, can you help me on that?
Please come again. We will do the question again.
Sorry, yeah.
My question is very simple. I'm talking about on matters policy as far as whatever your percentage is concerned, and I believe you are from another country, so we just want to compare notes, because on industry, insurance industry, they must face several key challenges, including technological disruption, cyber security threats, data privacy concern, regulatory compliance, and impact of climate change. Do you have, your country, does it have a policy that protects the service providers and the people who seek your services on matters insurance?
Okay, so I'll try and address your question, but I apologize if I get it wrong. So in our protection system, of course, there are new products that are being offered by insurance industries. For example, because of technological changes, they would have protection for cyber attacks or whatever. So the product offering from the insurer members would change depending on maybe more natural catastrophe that's happening and all that. So whatever they offer will change. So if your question is about how do we make sure that our protection system actually include all those new policies, all those new products that are being offered, what we have is actually we review our list of protected benefits every 3 to 5 years. So typically we do it every 3 years, and what we have on a yearly basis is that we get our members to actually submit a product list to our policy department in PIDM and look at whether or not there are new policies that are being sold or new benefits that are being covered under the insurance companies, and if they are significant enough, or if there are many people enough that are buying those policies, we would actually include as part of our protected benefits. So I hope that answers your question.
Thank you very much for that. We will fill the final 2 questions with a quick precision, and then you will answer them in totality, because we are now past time by 5 minutes. What were the other 2 questions? There was one here. The second one was? Okay, we'll take this one.
Thanks, Afiza. My name is Victor Mokua from Takaful Insurance of Africa. Takaful has been in operation in Kenya for the last 15 years. So it's good to hear from a counterpart, and Nigeria being the gold standard, I'm happy to have heard from you. So from prior presentations we've had that there is no entity that is too big or too small to fail. So my first question, do Takaful operators fail? You would understand that in the underpinning, in the way Takaful operators are structured, moving away from the RIBA, the GARAR, the MESIA, then underpinned within it, there are inbuilt mechanisms to protect the policyholders within that. So if they do fail, what is the data like? What are the numbers? Coupled with that, then if they do fail, what is the cause of these failures? Because if it's for the family Takaful, the long-term business, I would believe the asset liability matching on the sukuks is asset protected, it's asset backed in that spectrum. Number 2, it's interesting to learn that there is a PCF in your region. Then how does it relate with the Sharia boards on that end? I would also expect that there is a national Sharia board to sort of supervise in-house a lot of these issues. So how do you relate with that entity? And then lastly, Takaful operates on the concept of guaranteeing each other. So I would believe the members understand in case of a loss, we bear it together. So then I think for me it's a bit of explanation around this, how it is understood in your territory. Thank you.
Over to you now for the final response. You're muted.
Oh, okay. Sorry, I thought there was another question. So, okay, thank you for those questions. Your first question was, how would Takaful operator fail in our jurisdiction? We have not had any Takaful operator failure, but I believe the reasons for failure, be it conventional or Takaful, will be the same. So mainly it is mismatching, as you mentioned, and under-reserving was a major issue, and of course other parts of fraud and stuff like that. So I think those actually the reasons for failure would not change as much, even though for a Takaful operator. And I think Alistair had a good why insurers fail series that you can see that actually they don't run very much from each other. However, for Takaful operators, what we think would be unique would be the Sharia part of it. Because in our jurisdictions, if some parts of your product offering or your life cycle of your product does not meet the Sharia requirements, you can be asked to unwind the system, the policy. So if that happens in a large scale, that can actually bring down your actually entity, so that's the only, I think, idiosyncrasies when it comes to Takaful, the part about the Sharia compliance. But that's really just my thoughts about it. We really didn't have any specific Takaful failure as yet. Secondly, the question was on, okay, how do we interact as a insurance guarantee scheme? How do we interact with the Sharia Advisory Board? So in Malaysia, we have, we're very fortunate because, we are very fortunate that under Bank Negara, under their Central Banking Act, they have recognized only one Sharia Advisory Council, which determines Sharia resolutions, and their resolution is actually final and binding. So how we interact with that committee is because the secretariat of that committee is Bank Negara themselves. We actually work with the Secretariat to actually table our papers for Sharia resolution, and we table it at that apex sort of Sharia committee. So whatever resolution that we get from the SAC or Sharia Advisory Council of Bank Negara Malaysia is the highest authority in Malaysia for Sharia resolutions. So that's how we actually, we don't have our own Sharia committee because that is already the highest authority in Malaysia. What we are contemplating to have is just a Sharia advisory panel where our board can have access to, because Sharia is a technical as well as specific sort of area. They can have access to Sharia advisors, but the authority, the resolution comes directly from the Sharia Advisory Council of Bank Negara Malaysia. I hope that helps. The last one was okay. So for Takaful operators, as you know, they are risk sharing or mutual sharing risk participation. So that is essentially the definition of Takaful. So how does PIDM guarantee them guaranteeing each other? So for us, for PIDM's TIPS system, we don't use a Takaful contract for our protection system for our Takaful. So we actually use a guarantee, sort of third-party guarantee Sharia contract to actually underpin our TIPS protection system. So it's a bit different from takaful, because takaful means that one of the things is that takaful means that the premium that the members pay to PIDM is actually theirs. At the end of the day, if there's any surplus, you need to actually give it back to them. The risk of the concept of risk sharing. But for guarantee, for the basis of contract that we use, they pay us a fee for guarantee, and we guarantee them for the exposure that they provide to the policyholders. So it's a little bit different. It's a little bit technical. We can give you our papers on that if you're interested. So just maybe get in touch with Moses or get in touch with us, and we can share with you that contract. Thank you.
Thank you very much for the responses, and we appreciate for that wonderful and elaborate presentation. It has been a scintillating session just listening to you. And one of the gifts that you've been given is the melodic voice that is able to digress matters in a very malleable way. So we sincerely appreciate you for that. Thank you so much. And
yeah, I won't be dancing, yeah? No?
as per our usual culture in Kenya, whenever we have, do I focus on you so that she sees me directly? Okay, as our usual culture, we usually gift our guests after speaking to us, and because you are not here physically to receive this, they had suggested that they give MC your gift, but I told them I'm too generous, so I insisted that they mail it to you. So you we mail the gift to you as an appreciation for attending our conference. Thank you so much, and we appreciate
Thank you so much.
Thank you. Another
Our
round
pleasure.
of applause,
Thank you so
ladies and
much.
gentlemen. Thank you very much. Bye-bye. Thank you.
Bye.
Ladies
Thanks.
and gentlemen, we are now at the session that we take our very quick break. I appreciate the fact that the hall is now full, and I had promised people breakfast. Now there's still tea. This is what we're gonna do. We are going to take our break. It's 11:15, so we run it to latest 10 minutes past 11, so that we are able to catch up on the next session, which will also be online with a presenter from Nigeria. I'll be looking forward to a very interesting session. For those who watch Afro cinema, don't come with expectations of the same tone or accent, but come with the expectation of the lessons that will be continuing shortly. Now, I am also advised that we have with us Bwana Cliff. Bwana Cliff is the president of the Pan-African Insurance Intermediaries Organization, I believe. Association, yeah? Please rise and just give us a good wave. Let's appreciate Bwana Cliff for the Asante Sana. We appreciate your presence. Ladies and gentlemen, we are now going to take our very short break. Later, we'll be having a scanning code for us to get feedback. invite you to still scan the link on your screen just to allow you give us feedback on how the experience has been, what you think can be done better, and how often you will want us to hold this conference. In a short while, we'll be having our speaker from Nigeria giving the presentation, and I invite us back to settle in now and follow through the conversation even as we await the presentation. If you have any questions, please make sure to fill them appropriately, especially regarding the slides that will have been presented, so that we limit the scope of the questions. We invite you to scan the QR code on your screen just to ensure that you have given us feedback. For now, we can see Kabir Katata is on standby, who will be able to present a wonderful presentation lined up just for you. And whenever we are ready, the control team, we should be able to proceed without further ado, so that we are able to maximize on the time available. Once again, we welcome you back. If your neighbor is back, tell them to give you a smile. You may identify an object on their teeth and correct it before it's too late and the photos catch the moment. So give them a smile, tell them welcome back, tell them hope you enjoyed your tea, and in the process of smiling, observe anything that is out of the normal and smile back and tell them, that's how we correct with love, the African way. So, I can see we are nearly there. Moses, whenever we are ready, just give me a shout and we will be good to proceed. So, final announcement again. All the presentations and the link for the photos will be shared on your email address. In the evening, we have our African-themed gala dinner. The buses will be here at 5 p.m. to pick you, and they leave at exactly 5:45 p.m. Another announcement is that remember to scan the QR code that will be coming up on the screens, just to give us your feedback on the experience so far and what you believe we can do better to make this experience even amazing for you. And most important, have fun while at it, enjoy the moment and enjoy as you learn, because it's all about the good things that happen in life, and one of the good things is being alive to experience this moment. Moses.
Yes, thank you very much, MC Okari. Dr. Katata, can you hear me? Kindly confirm if you can hear me, Dr. Katata.
Hello?
Yes, I can hear you, but I cannot see you.
Okay. Good. So, can you see me now?
Yes, I can see you. So thank you very
good
much.
Morning.
Thank you very much, MC Okari. We are privileged this morning to have with us Dr. Kabir Katata, who is the Director of Research, Policy and International Relations, Department of the Nigeria Deposit Insurance Corporation. He is also Editor-in-Chief of the NDIC Quarterly, the corporation's journal. He has led and conducted independent large-scale projects in the corporation. He has served as NDIC representative on national, interagency, and international groups, and he has also designed and developed several world-class forecasting, risk management, and financial stability models. He was the risk hedging specialist for E.ON, the UK's second biggest energy firm. Kabir is a computational finance expert and quantitative energy strategist with broad-based power trading and risk management, quantitative finance, and petroleum risk management expertise. He has over 25 years experience in the design and management of technically innovative systems in multiple industries, including energy, that is petroleum and power, finance, government, telecommunications, and IT. He is a subject matter expert and has presented research papers on financial portfolio optimization, financial and non-financial risk management, artificial intelligence, customer profiling using historical data, power trading, quantitative energy, and deposit insurance worldwide. He has published in leading academic journals. Kabir is a certified Microsoft professional in several technologies. He has a second-class upper degree in computer science, mathematics, and statistics from the University of Abuja. He also has a first-class MSc in computer and network engineering from Sheffield Hallam University, and an MSc and DIC in finance from Imperial College of London, and a PhD in finance and management science from the University of Warwick, that is in the UK. So welcome, Dr. Katata. We appreciate that you've made time to join us this morning, and we are ready to listen to you. Kindly, Dr. Katata, you can share your slides.
Thank you very much. Thank you for having me. Is it okay? Can everyone see my screen?
Yes, we can see your screen.
And can you hear me?
Yes, we can hear you.
So good morning, everyone. As I said earlier, thank you for having me. I believe I have 40 minutes, right?
Yes.
Okay, so we are going to talk about key attributes for effective resolution regimes for financial institutions. And as you can see the contents, we will try to trace the history as well as discuss what the key attributes are. We'll also talk about the elements of these key attributes and what the resolution objectives are, as well as the preconditions. Then we'll discuss them and present a thematic review of these resolution regimes. You know that the financial crisis, global financial crisis of 2007, it really led to a lot of positive things in the financial system globally. You know, part of what led to it is that bank that failed, and it was realized that there were a lot of issues in terms of this cross-border financial institutions and group. So it was very important that the global financial system is able to identify and deal with those banks that used to be called systemically important or too big to fail. They are mostly banks, but as we can see in this assessment that is done, there are some actually insurance companies that were identified as globally systemically important institutions, even though the banks are leading, but it's not only the banks. Some insurance companies globally are also that important. So if the usual way of dealing with these financial institutions was government bailout. When they run into problem, then the government has to sink in money to be able to bail them out. And it has realized that that is not a good area to go, because the people that originate the problem, they enjoy what they have done, while government with scarce resources will pump money to sort out the problem. So in response to that, the G20 tried to deal with the issue of these institutions that are too big to fail. And one of these measures is the key attributes of effective resolution regimes, which was published by the Financial Stability Board. And the Financial Stability Board is one of the international standard setters whose main task really is the identification and bringing out policies. So having said that, as I told you that the global crisis of 2007, there were a lot of things that came into being to sort out the mess, because we realized that not only Lehman Brothers, but all financial institutions that are systemically important, we didn't know it. It's not well understood how it could be resolved. So part of those was, one, to build resilient financial institutions, which was basically the Basel III reforms and others. Also ending too big to fail, which is part of this is what we are talking about, the systemically important financial institution framework to address systemic risk, and then effective resolution regimes as a key, once you have identified, then you should be able to resolve. We also need more effective supervision, so that supervision is intense and is effective. Also, there was an issue of making derivatives market safer. Also enhancing resilience of non-banking institutions. Data gaps were identified, it needed to be addressed. We needed also to reduce reliance on credit ratings and then as well as improve risk disclosures. So a lot of actions took place because of this failure of Lehman Brothers, and one of those is the key attributes of effective resolution regimes. I think it's noisy from that end. I'm not sure it's from my end. Okay, so what are the key attributes? The key attributes set out the essential features that resolution regime should cooperate to enable authorities to resolve failing institutions in an orderly manner that limits the overall impact on economic activity without exposing public funds to losses. And these key attributes were endorsed by the G20 in November 2021. They basically outline the features that should be part of resolution regimes at both national and international level. This key attribute describe the powers which should be available to designated public authorities in each FSB member jurisdiction, and they bring about the orderly resolution of a financial institution to safeguard both financial stability and public funds. So what is being said is that you should be able to carry out resolution of any financial institution deemed systemically important without causing disruption to critical financial services and without losing confidence in such a system. So the aim of these key attributes are: one, to make resolution feasible without severe systemic disruption; one, not to use public funds; and then three, to protect vital economic functions. So these are the main objectives of resolution regimes. But to be effective, this resolution regime should also ensure continuity of systemically important financial services, whether it is payment, clearing, and settlement functions. They should protect relevant actors on the system, whether they are depositors, insurance policy holders, or investors. They should allocate losses to the firm's owners, that is the shareholders, and unsecured and uninsured creditors in a manner that respects the hierarchy. They shouldn't rely on public support. They should avoid unnecessary destruction and value and provide for speed and transparency when they are doing this. And they should ensure that non-viable firms can exit the market in an orderly manner. So basically, an institution that really shouldn't continue to exist, it should be taken out of the system. So the key attributes are not an international treaty, and they do not give rise to binding obligations for countries. Rather, they establish a non-binding standard that countries will be encouraged to implement, and that these key attributes recognize that the conclusion of international treaty is not currently feasible, and that some countries were not ready. But having said that, it doesn't mean that if you are part of this, you are surrendering your sovereignty. No, it's just an agreement to make sure that wherever systemically important financial institutions are located, they can be resolved. It brings about a lot of transparency, enabling cooperation. As we go through the key attributes, you will see what we mean. They are broad in scope, and there are a lot of attributes associated to it. So to be effective, there are preconditions for these key attributes to be effective. These preconditions, to be honest, are not only applicable to resolution, they are applicable to bank supervision, deposit insurance, all the financial safety net pillars. One, you need a well-established framework for financial stability, surveillance, and policy formulation. You need an effective system of supervision, regulation, and oversight. And you need a system for the protection of depositors, investors, and policy holders. You need robust accounting, auditor, and disclosure regimes. And you need a well-developed legal framework and judicial system. Why do we need these things? One, you need to be able to, in that system, to bring out policies that will shape the industry if there is a need for it. And then you need to be able to supervise and impose such policies. And for any operator in the system, whether it is a bank, securities, or insurance, you need to be able to protect the players within that system, the depositors, the investors, and the policy holders. And accountants and auditors, they provide an independent service while they confirm that, okay, this bank or institutions is being well run and blah, so this is all these things. And of course, last but not the least, a legal system that will ensure that if there is any need for redress, then people can get redress in time. So these are the preconditions for the resolution regimes to be effective. So these key attributes are 12 in number, and in summary, before we discuss them at length, they are scope, meaning that the regime should cover any financial institution that could be systemically significant. When we say, even though I've been talking about global, but you know that it's systemically important, it can be domestic for that jurisdiction. So in any country, any financial institution that is systemically important, ideally you should be able to cover it. You should have resolution authorities that are independent with clear mandate and powers to do so. You should have the toolkit, the available tools to be able to resolve that's available powers. There should be set up netting, collateralization, and segregation of client assets. This is key attribute 5. Legal safeguards. 6. You should be able to fund firms in resolution. You should minimize the use of public funds. This is very important. There should also be framework for cross-border cooperation, because some of these financial institutions, they act within borders. You have some truly pan-African institutions that operate in Nigeria, Kenya, South Africa. There has to be cooperation so that you can resolve this because of contagion and arbitrage issues. There should be crisis management group where the home and key authorities collaborate. There should be institution-specific cross-border cooperation in place to make sure that whatever happens, that's not the time you start looking for agreement. You should carry out resolvability assessment as key attribute 10. Then you should have a recovery and resolution plan available within just those jurisdictions. And then key attribute 12 is to share institution information to make sure that the authorities in both home and host have access to information they require. Sorry, can you hear me? Hello?
We can hear you.
Okay, it's just that earlier I had the MC saying that the lady, they shouldn't expect a very nice voice from me, but I feel my voice is also very nice. My Malaysian sister that presented, yes, it's a feminine voice, but I believe the ladies will find my voice very nice too, right?
They can confirm.
Thank you very much. So, the summary, we have just given a summary. Let's dive through these key attributes. Key attribute 1 is scope. Even though here we have said bank, but as we have said earlier, and as we can see, the key attribute established that any financial institution which could be systemically significant or critical should be the scope of a special resolution regime. It is intended that this standard should be met in each jurisdiction in relation to banks, security firms, insurance, and financial market infrastructure. So you can see that this gathering is firmly within this place. Any insurance companies that could be systemically important within Kenya ideally should be identified. This is what this thing is saying, and you should have the power to be able to do so. If, like, you have one agency that does this for all the sectors, which used to be then quite a few years ago, it used to be mainly the central banks that do everything, then they should have been able to identify any institution. But now you have regulators for banks, for securities, for insurance. Individually should be able to identify within their sector which is systemically important. Attribute 2 is that all jurisdiction, one or more public authorities should be designated to act as resolution authorities. And these authorities should be operationally independent in their role and adequately resourced. While there are multiple authorities within their respective mandates, roles should be clearly defined. In some jurisdictions, like in the US, for instance, in the banking sector, you have Federal Reserve, you have the FDIC. They are involved in supervision and regulation of banks. In Nigeria, the Central Bank of Nigeria is a resolution authority. The NDIC is a resolution authority. We all have resolution powers. So the mandate specified based on the act that establishes, and then an MOU between us will make sure that there are no duplication of tasks and no conflict, so that everything is very clear and coordinated. And part of that is that the resolution authority should know that they are pursuing financial stability objectives and to ensure the continuity of such financial institutions continue to provide the services they are established to provide. And in the process also that depositors, insurance policy holders, and investors are protected. And that whatever happens, there should be little or no destruction of value. That is key attribute 2, which is the resolution authority. Key attribute 3 is talking about having enough resolution powers. And what are they? Well, as authorities, you should be able to remove and replace the senior management of the firms that is given an issue. You should be able to appoint an administrator to take control of and manage the affected firm. You should operate and resolve the firm, override the right of shareholders of the firms in resolution, transfer or sell assets and liabilities. You should be able to establish a temporary bridge institution, establish a separate asset management vehicle, temporary. So this list of powers, ideally, even if you didn't have them as resolution authority, then you can see that which one do you need, and when you are changing your act, you should be able to have it. It's a very nice way of checking yourself, what is missing in your act, and based on what is happening globally, which power you should have. And these powers could be divided into 2. You have stabilization options, which deals with transfer of entire firm or of its business to another financial entity or bail-in. And then you have powers that deal with residual parts of an institution, which is to liquidate or to establish an asset management vehicle. Key attribute 4 is set up netting, collateralization, and segregation of client assets, which is legal framework governing setup rights, contractual netting, and collateralization. Key attribute 5 is safeguards, which ensures an effective and orderly resolution to establish a mechanism to compensate creditors for any losses that they could suffer. This is the so-called principle of no creditor owes of that liquidation, meaning that if you are going to liquidate a firm, then the creditors, whichever resolution option you are taking, they shouldn't lose more than they will have lost if you are liquidating it. And you need to have hierarchy of claimants, the insurance policy holders, the creditors, the shareholders. There should be hierarchy, and that you respect that hierarchy in the resolution. And key attribute 6 is funding of firms in resolution. There it says that you shall have privately financed funds. In the banking is deposit insurance. In addition, you may have resolution funds or a funding mechanism for export recovery from the industry. The goal is simple. There should be no public payout, and ideally there should be no use of public funds. Key attribute 7 is that there should be legal framework for cross-border, so that you can be able to coordinate and cooperate wherever this systemically important financial institution is. For those that operate within East African jurisdictions, you have to ensure that wherever a financial institution operates, then there should be cross-border agreement to be able to supervise and resolve that institution. Crisis management group is key attribute 8. This requires that to facilitate the resolution of the institution, it allows authorities to coordinate and develop prepared resolution strategy of the financial institution. And then key attribute 9, there should be institution-specific agreements. Wherever a financial institution is systemically important across countries, there should be agreements on how they will cooperate and to supervise and possibly resolve, if there is need be, of that institution. And then you should be able to carry out resolvability assessment to evaluate the feasibility of the resolution strategies. This is key attribute 10. Key attribute 11 is to have recovery plans. The systemically important will develop a recovery plan, which should be should have credible options to cope with range of scenarios, including idiosyncratic, specific to the firm, and market-wide, which affect the health sector, scenarios that address shortfalls of capital and liquidity and other things, and then resolution plan, which is the regulator's way of saying after the recovery plans have failed, this is how the resolution plan will carry out. And then most foremostly, you need access to information, because there is nothing that can be done whether it is on domestic cases or cross-border if there is no mechanism for sharing information for that resolution. These are the 12 key attributes. So they were released in 2011. So in 2013, there was a review of these key attributes, and because it has been recognized as a priority by the FSB, Financial Stability Board. So the first review, the objective is to evaluate the existing resolution regimes and any planned changes to those resolution regimes. The review compared national resolution regimes both across individual key attributes and across different financial sectors, banking, insurance, securities, and financial market infrastructure. And it provided a recommendation for future work by the FSB and its members. The review found out that while there has been a lot of work, of course it was only 2 years when it was established then, 2013, some other countries are in the process of adopting reforms to strengthen their regimes and align them to the key attributes, while some others, they lack some powers, like bail-in powers mostly, or to impose a temporary stay on the exercise of financial contracts. So it gives you an idea that if you don't have such powers, there may be a need for you to have them, since in the future you may need them. There was another thematic review also in March 2016, which examined bank resolution powers. This is mostly for banking. Again, there are some issues recognized there. There are some recommendations given to the banking sector, including to introduce missing powers in bank resolution regimes, review and extend the scope of their regimes and others. So whenever there is a thematic review, it examines the issues, it provides recommendations. So just to give you the journey of these key attributes, in the beginning, the FSB was adopted in October 2011. Then there were several thematic reviews on bank resolution planning, supervisory frameworks and approaches for systemic on implementation of bank resolution and deposit insurance reforms in South Africa. Then there are key attribute assessment methodology for the banking sector released in 2016, for the insurance sector released in 2020, and then non-bank financial institutions and others released also. And then in 2024, there was guidance, there was revision also, and some changes to the appendices and annexes that were carried out. Now, this is to give you an idea of the, this is published yearly on the FSB. You can see that you will see mostly banks now dominated, but however, if we come to this history on the right, you can see that it's not all the time that banks that were globally systemically important. Some insurance companies also have been globally systemically important, especially 2013 to 2019. It means that since 2020, the insurance companies in terms of assets and other criteria have not been recognized to be globally systemically important. The link is given below if you want to go and get the document, and then the title assessment methodology is also there. So in conclusion, the key attributes set out the core elements of effective resolution regimes that apply to any financial institution that could be systemically important or critical, and the key attributes were developed to be the gold standard resolution framework. They have been the backbone of cross-border coordination for crisis management and resolution, and they have helped guide many countries across the world in establishing national resolution regimes in a way that is consistent. Once you establish it according to the framework, then it means that you have established a global standard that is comparable to others. And the FSB's review of the 2023 bank underscored the strength of international regimes and the work carried out with that respect. And these failures, because since the establishment of the key attributes, there was no failure of a global systemically important bank until 2023, about 12 years later. So it was a test of, has it worked? You have been putting all these structures in place. What happens if a global systemically important bank fails? So this was the first test of it. So it constituted the first real test at a larger scale of the key attributes. So to close it all, this is a statement of Klaas Knot. I think it's the current chairman of the Financial Stability Board and also the governor of the Central Bank of Netherlands. He said planning is everything. That's the title of the speech. The FSB attribute and what we have learned from them. So what have we learned? What he said, in many countries, the designated resolution authorities are in place that possess the necessary legal powers and operational capacity to intervene in and resolve financial issues that are no longer viable. For internationally active firms, crisis management groups underpinned by cross-border cooperation agreements have been established. Global systemically important financial institutions have established recovery and resolution plans. They have worked on removing barriers to resolvability. And resolvability statements are being conducted to evaluate the credibility and feasibility of resolution regimes. This is what has made the key attributes groundbreaking. They not only answered the question, what does an effective resolution regime look like? And what are its key building blocks? They also provided the building instructions, starting from the end goal and then working backwards. Concrete enough to get to work and high level enough so that it will be applicable in widely different jurisdictions. In that way, it made the translation from the drawing board to actual practice. That was an extraordinary achievement. But perhaps the most important change the key attributes have brought about is that, apart from setting a standard for resolution, they also introduced a planning requirement. As US President Eisenhower said, plans are worthless, but planning is everything. And this is true for all forms of crisis management. And with that, ladies and gentlemen, thank you very much.
Thank you so much for that wonderful presentation. I can confirm, Doctor, that you have a good voice that is affirmative.
Thank you.
Been able to get us through the presentation in great perpetuation. In Kenya, there's a place called Roysambu, and at Roysambu we have the small Nigeria, so we have gotten used to the accent and we have enjoyed the presentation. So let's get the questions. Where are the questions? We have one hand here. Where is the other one? I have one hand. So we're going to get the one question and then you will be able to, yeah? Oh, yeah, it's, yes. Over to you.
Professor, thank you so much for that. I have listened to multiple presentations on the key attributes. That was the fastest and also the most comprehensive, so congratulations.
Thank you.
A practical question. The FSB's primary driving instinct was around bank failure, bank risk, and systemic banks. These key attributes are also comprehensively being applied across the insurance sector. Do you think there are areas where that might be treating the insurance sector incorrectly? For instance, it's very hard to see bail-in as a solution for insurance. What it normally means is a haircut for a claimant. And if somebody is receiving long-term disability payments from their insurance company, asking them to bail in by cutting their disability benefits is fundamentally unfair. Are there elements of the key attributes that should be uniquely fine-tuned to reflect the insurance sector versus the bank sector?
Thank you very much. I believe that is only comment and question because he combined both in a single expression. Thank you very much. You know, as you stated earlier, really even if you have seen from my presentation, the dominant institutions are the banking sector, and principally largely because of the total asset and other things that dominate the insurance. But the beautiful part of the insurance is no one understands risk and how to treat it like the insurance sector. So the bailing is brought about because of the appetite of this actors in this sector to be forced to be shareholders. Perhaps I won't say that the insurance sector is not well treated, but you are right. The main focus in the beginning was the banking sector, and they continue to dominate. Perhaps it's time for the insurance sector to also put on the thinking caps and bring about a better alternative. Because as you said, that bail-in is really, you can't bring it to the insurance sector. I say I'm bailing you in. But there are beautiful risk transfer tools I'm aware of, beautiful tools in the insurance sector which they can somehow ingeniously perhaps be applied. I don't know any sector that knows and understands risk like insurance. I stand to be corrected. And even if you can see the dominance of the banking, so most of the emphasis has been on the banking. Perhaps that is a lesson for us to look at. And also that perhaps the insurance sector, when there are exposure draft and all the discussions by the FSP, the insurance sector should actually try to also bring about the innovations that they have to make it a lead. I agree with 100% with what you have said. The bail-in is not really for it, but there are alternatives which unfortunately I'm not sure the insurance sector has sort of tabled or has brought out quite a few that can really deal with the sector. But the insurance sector is able to deal with itself because the tools in the insurance sector are numerous.
Thank you very much for that. I want to confirm that from the audience, it has been a very captivating presentation, and we look forward to have you next time physically with us so that we get to enjoy your great nuggets and your presence, because I noticed that you are present fully on the screen, delivering the experience of a lifetime. Another round of applause, ladies and gentlemen, for that wonderful presentation.
Thank you.
And yes,
thank you very much. Thank you.
I think the compliment on the voice was able to put you under serious pressure because you brought out your A game while at it. So thank you so much once again.
Thank you. Have a nice conference. Thank you.
Thank you very much. Ladies and gentlemen, we are now on to our final presentation of the conference. But before we do so, we want to confirm that we have had great deliberations so far. Somebody take a photo of this. I want to show my parents I made it in life. I appear on full screen. Thank you very much. Thank you. Please take a photo. Anyway, now to the final part of our presentation this day, ladies and gentlemen. We are now going to have a wonderful, one-of-a-kind presentation. But before we do so, I notice people who are starting to drop a bit in terms of just nodding their heads in appreciation, and we will note them in good style. So this is what we're going to do. Just look at your neighbor. Just look at your neighbor. Have you looked at your neighbor? Now, present your hand in this way. Your hand that is near to the neighbor. So I don't know which is easier. Okay, that way. Now, once you present, tap that hand. Now, I will allow you to only tap that hand when I mention this word, PCF. Okay? So anytime I say PCF, you tap your neighbor's hand. Please don't tap when there's no word PCF there. Are we good? Let's try. Here goes my story. The journey of life can be equated to the challenges that PCF tries to address. And as you join in the PCF conference, there's one thing that you will notice that we will not prefer to talk about, and this is failure. Sometimes failure is not very pleasant to talk about, but from failure, we get to big lessons, to pick lessons that are so big and can be addressed in the PCF conference. But in the PCF conference, you need to remember one thing that has been very clear so far, and that is the ability to bounce back and get people on the move even when failure has happened. So at PCF, we deliberately intend to ensure that life goes on very well even when failure happens, because PCF believes in the aspect of getting to rise people back on their feet and giving them a new lease of life. And that's why we trust PCF to deliver the experience, because we are happy to be at PCF and we look forward to PCF impacting our life in a PCF way, and that will be peaceful. I got you. I got you all. Awesome. Now, we are going to have our final presentation coming from Mrs. Helen Chepkwonyi. Mrs. Helen Chepkwonyi is the Chief Executive Officer of the Kenya Deposit Insurance Corporation. She brings over 20 years of experience in leadership and management within the financial sector. She holds a Master of Arts and a Bachelor of Arts degree in economics from the... You know, a friend of mine reminded me that having studied in the University of Nairobi, there's a way we describe ourselves. So this is the opportunity I've gotten. She has a Bachelor of Arts, a Master's of Arts, and a Bachelor of Arts degree in economics from the greatest university south of Sahara, north of Limpopo, east of the Greenwich Meridian, west of New Zealand, the only university with article there and preposition of, and the university that has a road in the capital city named after it, the University Way. I'm referring to the University of Nairobi. She has worked in... Yeah, she has worked in both the public and private sectors with a focus on building strong teams and improving processes to enhance efficiency and productivity. Before becoming a CEO, she served as the head of risk and bank examination at KDIC, where she played a key role in the corporation's transition into a fully fledged state corporation and deposit insurer. She also previously worked at the Central Bank of Kenya as an economist and risk professional. She is the Deputy Secretary General of the Africa Regional Committee and Executive Council member of the International Association of Deposits Insurers, reflecting her contribution to strengthening deposit insurance both locally and internationally. Ladies and gentlemen, we bring before you a lady who is the clearest definition of beauty and brains personified, ready to deliver an experience and a presentation articulated in the best terms possible as the final presentation in this inaugural conference, and with the excellence and touch deserving of this very audience. A round of applause as we welcome her for this presentation. Keep clapping until she arrives. We welcome you. Karibu sana for your presentation.
Good morning, everyone. Hey, that was a serious introduction. Yes, as you've been told, my name is Helen Chepkwonyi, and it's my pleasure to be here in this conference. It's such a wonderful conference. As you are aware, KDIC is a sister company to PCF. We deal with the banking sector, and PCF deals with the insurance sector. So when we were invited for this, it was really a pleasure for us to participate, and we look forward to greater collaborations and working together, because all of us are the financial safety net players within our country. So by way of introduction, KDIC, as I mentioned, is part of the financial safety net players in the country, and our job, we were set up to provide deposit protection. So we provide deposits. I know all of you here are put your money in a bank or a microfinance institution. So all of you are our members as KDIC, because by virtue of the member institutions, We currently have 52 member institutions. Those are commercial banks and microfinance institutions that are licensed and regulated by the Central Bank of Kenya. And therefore, whenever you put your money in your commercial bank, our job is to ensure that that money is well taken care of by the banks. We monitor those banks to ensure that any risks that they are taking are not bad, or they are not likely to cause a failure. So our job as a KDIC is to enhance the public's confidence in Kenya's financial system. So, and I know this is also your mandate as PCF, because we are all financial safety net players, is to enhance the public confidence in Kenya's financial system, to ensure that people are able to, our depositing public are able to confidently walk into their commercial banks or microfinance institutions and put their money there and go home safely and sleep knowing that their money is safe. And we do so by providing deposit insurance. Of course, by the word, by the name, deposit insurance. We provide coverage of up to 500,000 shillings of any of your deposits. So whenever you have your money in a commercial bank or microfinance institution, in the unlikely event of a failure of that bank, we as KDIC are giving you that guarantee that will pay you up to 500,000 of your deposit. And surprisingly, that is 99% of all the account holders in this country have 500,000 shillings and below. And therefore, that is a good sense of cover. And okay, in terms of value, it is low. It shows you the skewed nature of our deposits in this country. We currently have we see one of the banks or microfinance institutions is heading in the wrong direction, we have the powers to actually visit with the institution and ask for some measures to be undertaken to ensure that we prevent that bank from failing. At the same time, the close collaboration between the supervisor, the Central Bank of Kenya, and ourselves is what is enhancing the early intervention measures that we are undertaking. And not to brag, but I think we've not seen a bank failure in the last 9 years in this country. It's because of the early intervention measures that are really being put, and mostly at the Central Bank. By IADI. Today I am really trying to put my best foot forward by bragging about what was happening. But anyway, that was 2016. And KDIC, in 2019, we launched what we call the differential premiums system. In the differential premium system, let me explain that as a deposit insurer, we charge premiums to our member institutions. The commercial banks and microfinance institutions pay us 0.15% of their deposits as a flat rate, and then we charge a differential premium based on their risk appetite. So in this, we are trying to encourage the banks and microfinance institutions to do their business well and to manage their risks better. Therefore, we reward those that have the best premium, the best risk management frameworks in their institutions. Then they only pay the 0.15. Those that have risky appetite are charged a differential premium. And all this is a way of trying to ensure that we have a stable financial system. I think I have already mentioned then the next slide on the mandate of KDIC. One is to early detection and intervention. I've mentioned on that. Prompt resolution by way of once we have been appointed either as a receiver or as a liquidator by the Central Bank of Kenya, our job at KDIC is to ensure that we make prompt payments up to the 500,000, and this we do through our fund. We have built over time through the investments of the premiums we receive from the commercial banks and microfinance institutions, and this buffer, this fund, is what is supposed to support the financial system by telling the public that we are here, we are strong, and we have this fund. If in case of any failure, you should not worry because you will get your money back from KDIC. And therefore, the easiest, if we are able to pay the depositors maybe within 1 week or less, that's our target as KDIC. It will make it institutions. So so far we've wound up nine institutions, and we are currently in the process of winding up another 4. Winding up is such a hectic process that really takes so much of the time, but that is the end result of once a bank has been put in liquidation, the end result is to wind up and pay off all the depositors of that institution. Now, coming to the topic of today, I was given a task to discuss on crisis communication. As you are aware, during bank failure, or just even with insurance companies, when they fail, it causes some form of disruption to the market, and it causes some crisis in the market. And therefore, how we deal with the communication is very critical. The banking sector or the financial sector in general is very sensitive. Any information that is put out there really causes some panic in the market, and therefore we really are disrupted, and therefore how we manage, how we communicate to all those people that are affected is very critical. In communication also, the role of the public confidence is very important. At all times, whenever we are making when we are communicating during a crisis, it is important to really bring about the confidence, the public confidence, by ensuring that if you'll recall, some of you during the last failures of the banks, there are many. Next slide, the key principles on crisis communication. One is timeliness. The next is transparency, consistency, and accuracy. All those are key principles that ought to be put in mind whenever we are putting out communication. As you are aware, and I believe in the last bank failure, that was in 2016, there were certain sets of communications that come out. In Kenya, we have a communication plan that involves both the CS National Treasury, the governor of the central bank, and the CEO of KDIC. All those, if in case they have to, there is a chain of events that sets up. Once a bank has been identified as non-viable, the governor of the central bank is the one that informs the CEO of KDIC. The following day, there is a press statement issued by the Central Bank of Kenya, the governor, and also the CEO of KDIC. In case of a domestically important bank, if the bank is important or systemic in Kenya, then the CS, the National Treasury, will also make a statement on the same. So, and all these statements are aimed at making sure that at any time the depositing public are made aware of the issues at hand, or on the story about the bank that has failed, giving accurate information about it, and what the plan KDIC is doing about it. So the next slide, I'm talking about what I had mentioned about the crisis communication plan. In this crisis communication plan, it provides the guidelines for coordinating an organization's communication and response in the event of an emergency or a disruptive event. So in this plan, it defines the crisis communication team, who will be in that team, and their roles and responsibilities. There is also the detailed steps to be taken in communicating during a crisis. It also indicates whom to contact, the resources required, and the procedures to follow, and it also provides a platform for preparedness and improvement. And this, I'm just giving the next slide on the process. The process I've mentioned, the first stage is on the alert. Once the central bank governor alerts that there is likely to be a takeover or a failure of a bank or microfinance institution, the first stage is the alert. Once the alert is done, usually at night, then the following day there is a takeover. All the branches of that bank or microfinance is taken over, and then the second stage of assessment of the crisis or assessment of that problem that we are having. Is it systemic? Is it small? And is it something that can be, if a bank can be either returned back to its job, to its business, or whether it's unresolvable? Those are the discussions that are being taken. And I'm doing both as an individual or a bank failure, or now when it has culminated into a crisis. Some bank failures do not cause a crisis, but some failures, because of the nature, if there's a contagion effect of a bank failure, even when it is a small bank, sometimes can cause a contagion on the other banks, and therefore kind of some mini crisis. You will recall when we had Chase Bank, when Chase Bank failed, and fortunately it was put in receivership. But because it was not a big, Chase Bank was not a big bank, it was a tier 3 bank, but because of its connectedness, the level of its connectedness and the MSMEs that it was handling, it became systemic in the country, and therefore some assessments are done during the process, knowing that even though a bank might not be a tier 1 bank, a big bank, but because of the level of connectedness, then a decision has to be made, because they can cause its closure or its full liquidation can cause ripple effects on the economy, and therefore the government has to undertake other measures to make sure that that disruption is minimized. So now, we are assuming now that if there was a failure that is actually likely to cause a crisis, a banking crisis. A crisis is a reduction in confidence in the banking sector, where people are withdrawing their money, even from banks that are not affected in the failure. So for instance, if there was a failure of one bank, people just do not want to, they do not trust the banking sector anymore. They go and withdraw their money and take them home. And therefore, what we do in such situations are to do, we formulate the messaging of our, the messaging of our communication messaging to ensure that we really bring about the confidence in the sector. The fifth step is the dissemination, and thereafter now, once the calm is being brought, the step 6 is monitor and review. The next slide, we are looking at resolution in financial institutions. So I think I've been going back and forth. In the discussion of the crisis communication, I've also discussed about resolution of financial institutions, because the work of resolution and crisis management and communication go hand in hand together. As we are doing resolution, we are also managing the communication aspect of crisis communication. So it involves resolution in financial institutions involves protecting depositors, managing assets, and restructuring or liquidating failing institutions. Our previous presenter, Dr. Katata, I think at some point mentioned some of the resolution tools that we use in managing a bank failure, and one of them is on what we call the transfer and exclusion, where we carve off the assets of the bank that has failed and transfer it to another bank, so that we are only left with a good bank. Because in this way, we are able to kind of manage, the depositor is not so much disadvantaged, because they are able to access so much of their money. This is what was used during Chase Bank. When we had a Chase Bank failure, we had what we call transfer and exclusion, where 75% of the depositors' money were paid through SBM, and only 25% of it, of the bad book, came to KDIC. In this, we see it as a better way of ensuring that the depositor is able to get their money. Going to the next one, the importance of crisis communication during a resolution. During a resolution, or when there is a bank failure, there is need for clear and timely communication that helps to prevent confusion and panic among the public. It ensures that depositors, policyholders, and stakeholders understand their rights and the resolution process. Transparency is key to maintaining the public trust. And in this case, during the crisis, some of the crisis communication might not be in terms of press statements and going to, to the TV stations and talking, which is very important. But sometimes we might have to take it through actions. If some of you remember, I think in 2005, there was a big bank that was having a run. And what the central bank did was just they provided a lorry or something that that showed that they had money. So when people were queuing to withdraw their money, they were just showing people taking in money. And by the end of the day, people had returned back their money because it was fruitless, just to show confidence that the bank, if the bank is resolvable, if there is an issue with a bank that does not have any problem, is resolvable or is solvent. If a bank is solvent and does not have any problem, there are ways of making sure that people have confidence by ensuring that they are availed cash. And therefore, in that incident, I think it only took one day, and people who had withdrawn their money were able to return back their money. So there are instances where we also communicate non-verbally. The next slide, I'm just giving you a template of what our press release does. So as part of our communication plan, we have templates that shows who needs to say what, because during a crisis, when one bank or many banks have failed at the same time, there is no time to really craft on matters, and yet there are key messages that need to be brought out. So as part of the communication plan, we have set up templates that shows during a receivership or during a liquidation, when we have been appointed as a liquidator, or when there are any discussions within a certain bank on the possible actions that are being taken. So the reason I just brought this is just to show you the kind of things that in the crisis preparedness manual, that these are the things that we need to have in place, and we need to have the sequencing, as I've mentioned. If there has to be a meeting with the CS National Treasury, there has to be the governor, there has to be KDIC, and at that time, when decisions are made, who speaks first, who says what, and who will speak on which matter. And therefore, those discussions are done during the time of peace, so that during that crisis, everybody knows who's their own tasks and what needs to be done. My next slide, I'm just trying to bring about the challenges in crisis communication for resolution events. One of the challenges that we have is the uncertainty. The complex nature of financial crisis can create confusion about the resolution process. Part of our crisis preparedness and even crisis simulation exercises that we undertake, and by the way, we did one, and I hope in future we'll be incorporating even PCF during crisis simulation exercises. For instance, when we are dealing with the regional banks, most of the Kenyan banks are also within the East African region, and therefore their issues are much different from a small bank or a microfinance institution, and therefore we have to take care of the legal implications in Kenya, Uganda, Rwanda, Burundi, South Sudan, and all those that have branches or they have of the same bank, that Kenya is the host of that institution. And therefore, the communication, even as we are doing during a crisis simulation, even the crisis communication also have to take into consideration those aspects, that if it is a regional bank and maybe the risks might have emanated from Tanzania or another of their subsidiaries, and it can affect the Kenyan one. So the contagion effects of all that has to be taken into consideration. Misinformation is the second challenge. Rumors or incorrect information can undermine the public confidence. And the third one is stakeholder coordination. I'll be mentioning, and I've mentioned a lot about stakeholder coordination, because the banking sector or the financial sector in general is so fluid. The public confidence in the financial sector is very critical at all times, and therefore any issues, any problems that can emanate either from the capital markets or from the insurance sector, from the pension industry, from the banking sector, can cause a crisis in the economy, and therefore a greater coordination of the stakeholders of all those institutions is very important. And managing communication across multiple parties like regulators, I've mentioned, like right now we coordinate well with the financial sector regulators, IRA, RBA, CMA, CBK, in ensuring that we all pursue this mandate of ensuring that we have financial stability in our country. And pursuing that, especially in the communication era, is very critical, and it can be challenging sometimes. So my way of just finalizing, the next slide, I'm talking about building public confidence during resolution events. So some of the key pillars on what we need to do is, one, communicating the protection of depositors and policy holders. So at all time, communicating is very critical for any confidence to be, public confidence to be enhanced. Giving regular updates on the resolution process. If I had time, I would have given you on some of the templates of press statements that are given. The first one is given, the following day there will be another one, after 3 days there is another one, just to continue to enhance confidence in the public and giving additional information about that bank that has failed. Highlighting the role of the institution in ensuring systemic stability and deposit safety, engaging the media and stakeholders to reinforce the message of trust. So basically in this slide, I'm trying to bring about the aspect of enhancing public confidence is something that is very critical, not only during a crisis or when there is a failure, but even throughout our job is to ensure that we enhance that public confidence through greater stakeholder engagement. My next slide, I was just trying to bring about the role of the media in crisis communication. You know, the media is our mouthpiece. They are the ones who can break or make during a crisis, and therefore engaging them and having a good rapport with the media is very critical, that they get the facts right and that they are able to deliver on that messaging well. So media serves as the primary channel to deliver messages to the public. It is critical to maintain media partnerships to ensure accurate reporting. Proactive media engagement is necessary to combat misinformation, and regular press briefings, interviews, and public statements help to manage the narrative. So the next slide, I'm talking about the lessons that we've learned from the global and regional case studies. So I think some of our past presenters had also mentioned during the global financial crisis, even the SBV in the US recently, that the financial crisis, if not well managed, the communication, if it is not well managed, can exacerbate or worsen the situation of an institution. Regional examples, we can mention of bank failures that we've had here in Kenya, Uganda, and how those were improved, or the effects of those failures were managed better because of better or successful communication strategies that were used. And our key takeaways on this is that we need to have a clear, a consistent, and timely communication that at the end of it reduces panic and restores confidence. Going next, I'm just speaking on the best practices in crisis communication for resolution events. So I think this is just a summary of what I had already mentioned. We need to have the pre-crisis communication plans. We need to have, in those plans, we need to know who is doing what, and at what time, the sequencing of how the communications will take place. We already have the templates that have already been prepared, and the communications teams that are dealing with it. And during the crisis itself, the real-time updates, the transparent messaging, and addressing public concerns. This is very critical to determine how long a crisis can take. If a communication is very effective, we will be able to manage that crisis within a shorter time. And then for post-crisis, continuous communication and recovery and lessons learned is very critical. Continuous review and monitoring of the messaging that we put out on in our communication is important, and how the public is taking it. Next slide, we are looking at the future of crisis communication in financial resolution. The future of crisis. So going forward, we embracing technology is very critical. And like previously, we used to have bank runs. When we had a bank run, we used to see queues in the branches of that bank. Nowadays, there is no queuing. There is all the monies, or even the information is through WhatsApp groups. Somebody says, oh, this bank is having a problem, withdraw your money, and the money can even move faster. And therefore, we as deposit insurers or as financial safety net players have to also combat that quick response to ensure that the communication is fast and timely to be able to combat such an issue. Yeah, I was just mentioning in those days of 2005, when there was no M-Pesa or there was no technology, people had to actually hear first that there's a problem in this bank. Then they have to go to the bank, go and fill in a slip, queue. Then that is when you would see the problem. But now you don't have to see anything. There will be no queue in any bank, and yet money is flowing out of that bank. And therefore, the issue of embracing technology is very critical. Enhanced social media strategy is also, information is very critical. Increasing public awareness, educating the public about the resolution process and their protection. I need to emphasize this. KDIC, just like PCF, creating awareness or enhancing the public awareness about what we do is very critical in enhancing people's confidence in Kenya's financial system. People need to know that we exist in the first place. If people don't know that KDIC exists, then if in case they just read on those family WhatsApp groups that there's a problem in this bank, they'll just be running, withdrawing from this bank, taking to another bank. The next they hear, oh, there's a problem in that bank, they withdraw. They keep on moving like that. But if they knew that there is a KDIC that is strong and is able to pay up to 500,000, and 99% of the account holders hold 500,000 and below, then it do not matter to them knowing that there is a strong state corporation that would be able to pay them up to their money. And therefore, this business of moving from one bank to another will cease. And therefore, public awareness of our existence, just like PCF, is very critical in enhancing the confidence in Kenya's financial system. And in conclusion, I'll just mention that crisis communication is vital to maintaining public trust during resolution events. And effective communication strategies can ensure a smoother resolution process and prevent unnecessary panic. And I think with that, let me say thank you very much for this opportunity. Thank you. MC, are we taking any questions, or I guess it's
Thank you very much for that wonderful presentation. And I like how you signed it out in style, just like a banker. Now, we have an opportunity for 3 questions at the maximum. I have one on that end, I have the second one here, and I have the third one. Anybody closed? Sorry for that. So I'm going to the far end. Would you want to for them to ask all of them and then you answer, or
Yes.
you answer each of them?
All of them.
All of them to come. Okay. Right, we're starting on the finance. Okay.
Thank you very much for a very nice presentation. My name is Caleb Mungala from Light of Hope Away from Home, which is a organization that is advocating for budget making process and financial issues, policies making, and even advocacy. My quick question is on the act that governs the KDIC, which it's KDIC Act 2012, GAP 487. I think we need to review this act. It has taken a quite while and things are changing. It's high time we review it. And this act only gives you mandate to take a look of the bank sector. But we have other areas where money of many thousands of Kenyans are being misused or even lost, which is SACCOs and Shylocks. They are not part of the areas you are supposed to check. But I think we need to even incorporate them, because nowadays a lot of people, especially the low-incoming areas, they believe SACCOs than banks. Can we, per your opinion, do you think it's the right time for us to review this KDI Act of 2012? We can incorporate the SACCOs and the other relevant bodies that are in this banking sector. Another thing is about creating awareness. I'm very much happy I was one of those people who participated at KICC when you called the multi-sectoral stakeholders to discuss matters banking in Kenya. But the truth be told, there's still lack of information when it comes to those people from the market, those people from the low-incoming areas. They still don't understand the safety measures that have been put in place to make sure that their money is safe, be it in bank, but also we need to incorporate the cooperatives. So what is your plan when it comes to creating awareness up to the local level?
Thank you. Now, we will proceed to the second. Yes, yes.
Thank you, Madam Helen Chepkun. I have two questions, very basic. One, I'm here, Madam. Thank you for noticing me. The threshold, I mean the 500,000 is limited to a single account or a depositor, because you might have 5 accounts in different formats in a bank that goes under. That's one. Number two, under your mandate or regulation, do you have plans in terms of acquisitions or mergers when some of these companies goes under? Thank you.
Thank you, Madam CEO, for that very elaborate presentation. My name is James Njogu, PCF. You've given an example of a bank running that we had in the country whereby there was misinformation and the like. And in today's world, we are living in the world of AI, digital information, misinformation, and fake news. What do you think is a greater role for the regulator to reach out to depositors out there in terms of giving them awareness, or in essence whereby they say information is power, but at times fake news travels faster even before the media gets the time to correct itself. How can the regulator, from your experience, demystify itself to the ordinary depositors to know what the 52 banks or so do in terms of regular publications and engagement? You've come up with very good recommendations, but more often than not, we don't see them applying in real sense, especially to the younger generation of depositors. So I would wish you give us better alternatives that we could employ, noting even the financial sector growth in terms of issues to deal with other issues to deal with Bitcoin, cryptocurrency, and the like, where there is no clear position from the regulator. Thank you.
Thank you very much. We have had 3 more questions coming through, so I believe you still have the capacity to note them and then we address them.
Or I can answer this. And
Let's
then
answer the 3 and then we can handle the other 3.
The first question was on the KDI Act 2012 Cap 487C. You had asked whether there is any opportunity to review the Act to also include SACCOs and Shylocks. Now, I have a problem with the last one. What I know with the SACCO Society, we've been in talks with the regulator, SASRA, and I think they are in the process of setting up a credit guarantee scheme for SACCOs. This is an area where the National Treasury, which is our parent ministry, could be considering whether we as KDIC can take up also on the support for the SACCOs, or whether a similar setup will be done for SACCOs to ensure that they are also covered in the event of failures. Let me mention that we deal with deposit taking. Shylocks are credit only. So there are many, even microfinance institutions that are not within the ambit of the Central Bank of Kenya, and yet they take up so much of the deposits. But because they are not deposit-taking institutions, then they are not within the ambit of regulation by the Central Bank of Kenya, and Shylocks are part of it. And some of the other, what are they called, SACCOs or chamas are within that, because they were set up specifically for credits. So what you do is you put in your little money and for you to be able to be lent money. Therefore, they are not deposit taking. So we focus more on deposit taking institutions. But maybe that's a discussion for future, because we've seen a huge growth in that area that is not supervised, and therefore even a failure or a problem within that area, we cannot just close our eyes and say, oh, it's not within our ambit, because the problem can still seep in to the formal banking sector, and that is a subject for discussion even as we go. So we know that we have the credit guarantee schemes that have been set up even at the National Treasury, but this one is only for the what is it called, the MSMEs, the hustler fund, the people who are borrowing little monies. Therefore, they are guaranteed in case of their failure to pay. But that is slightly parallel to what we do at KDIC. You also mentioned something on creating awareness. Oh, when you mention public awareness, that's my baby. I really feel like we need to enhance our public awareness, both ourselves as KDIC, because the more people are aware of our existence, the better they are confident about the financial sector. And it was in this light that in our strategic plan 2023-28, we put in place that we would take, within that 5 years, we need to create our awareness index from the current. We had it at 9%, it moved to 14, currently it is at 32%. We really want to work towards increasing that awareness. You see the numbers are very low, and therefore it is no wonder that even when we are still going to places to ask people, customers, to come for their money, they know when the bank failed, some of the banks that failed 20 years ago, some people have never come for their money, and yet we have their money. We have recovered money, we want to pay them, they are nowhere to be found. They did not know that there was an institution that is supposed to pay them. Currently, we are sitting on very many titles of people who, if they came and at that time when the bank was failing 30 years ago, they had borrowed very little money, 20,000. If they were to pay a certain amount, they would get their titles back. But they are not even aware where they know their branch was in Kisumu and it was called the BT. When it closed, they just kept quiet and nobody. And therefore, it is a task that it is with us, and we really need to work on that. And we've done this, as part of our strategy, we have developed what we call town hall meetings, where we go to various towns within the country and engage the people there to tell them of who we are and what we are doing. And with that, we've been able to even get depositors to come and make their claims of their deposits, and some of them come for their titles and pay off and clear there. And this is something that we'll do going forward, and we can even collaborate with other stakeholders. We are in the process of working on something with the Kenya Bankers Association, with the Central Bank of Kenya, to do a kind of consumer awareness, or people to be aware, depositor awareness on what they need to be doing, or what needs to be done within the financial sector. And that goes into the second question somebody asked about what the regulators are doing. There's something that is being done within the Kenya Bankers Association with the CB. As KDIC are also participating in it, in ensuring that the public, the depositing public, are made aware of what activities are going on within the banking sector. There was a second question on coverage. Is it single or per depositor? We currently cover per depositor. So it's not, we don't cover each of the account holders. And so what happens is when a bank has failed, and we know we can just, by use of your national ID or we can be able to aggregate or put together all your accounts and be able to pay you up to 500,000. There was a second question I think you had asked on mergers and acquisition. Yes, part of our resolution tools that we are using, especially during the early interventions, have been where when we identify a bank is weak and yet it has a niche. Let's say there are banks that are maybe microfinance institutions that are targeting specific areas, and yet they are not so badly off, but because of the economic situation in the country, then at this time those are the ones that are targeted for being bought, or yes, for being merged with others or to be acquired. And therefore you saw so many of the banks that were having trouble in 2021-22, I think even 2023, we had some banks that were acquired by the big banks. And therefore, with that, we were able to avoid a situation where there are bank failures. So mergers and acquisitions are tools that we are able to kind of push, and through negotiations and through putting together the numbers, we are able to convince this bank that is having problems that even in case of it, instead of it being put in liquidation, you are better off being bought by this big bank and able to transfer all your depositors and your debtors to this new bank. And this has worked because the disruption has not been there so much within the last 9 years. The third question, I think James, you had asked about, I think I have answered part of it, that there's need for greater role for the regulators. I agree, and the regulators have really been working on, if you've noticed, there's a lot of collaboration, even in establishing on the financial stability review. There are things that are done across the financial sector, both the insurance, the pensions, the capital markets, and the banking sector. All of them do a financial stability review to ensure that we know exactly what goes on within our various sectors, because we cannot just sit pretty and say, oh, the banking sector is okay, because a risk can emanate from another sector. The capital markets can cause, if there was a problem there, and it can hit either the insurance or the banking sector. So we cannot just say, oh, my house is in order. You need to know what is going on in the other houses, because we are all interconnected within the financial sector. And I agree, there is still need for more greater collaboration within the financial sector, safety nets, to ensure that we bring about that confidence. Thank you very much.
Thank you very much for that. For the next series of the questions, because they were additionals, we will require very brief responses to those ones.
Thank you, Madam CEO. My name is Sopani Gondra from the Reserve Bank of Malawi. And thank you in advance because I know my colleagues are at the KDIC again this week. Thank you very much for hosting us. I wanted to understand whether the crisis management framework that you have shared this morning is anchored in your law, whether this is legislated, that its coordination arrangements is supported by law, or it's just in practice to do this coordination. And also just a clarification, whether the framework you have shared us with this morning applies only in times of a crisis, and my little understanding of a crisis in terms of the FSB attributes is an episode that has got systemic implications, particularly even in the real sector. I want to understand whether the coordination arrangements you are sharing with us here apply in that context, whether you probably have got a DCB or you have got a bank that has got systemic implications and you need that coordination with the central bank or the Ministry of Finance, and who takes the lead if that is the case, or whether this crisis you have talked about is applied even in cases where they are just the idiosyncratic failures. A single small bank out there has failed, which could normally be resolved under normal supervisory corrective action, or whether the same principles you have talked about here or also applies. That's what I wanted to get from you. Thank you.
Thank you very much. The second question.
Afternoon, Madam Chepkwan, and thank you so much for the presentation. My name is Noella, and my question is mainly one, you mentioned that the roles were differentiated by the changes in the law. So as of now, how do you prevent any overlap of roles between KDIC and the central bank? Also, how exactly is your relation between the two institutions? And again, when you receive reports from the various institutions, do they pass through the supervisor to KDIC, or do you receive them from KDIC in real time, or something of the sort? I don't know if you would be able to expand on that. Thank you.
The final question comes all the way from Uganda.
Thanks so much, Helen, for the wonderful presentation. Asante sana. I wanted you to tell me, in terms of emphasis, where do you put more effort, considering guarding against failure and payment when failure has occurred, in line with the work of the corporation? Because I know this operation was put in place to help depositors whenever a bank was under. But my concern is on the fact that we need to ensure economic stability. And ensuring economic stability means that we should put more emphasis on avoiding failures than on paying depositors when failure has already occurred. Remember, the bank's business is an important part of the economy, and despite the fact that depositors get refund, the bank has got much more impact on the economy. So we should emphasize having the bank helped in one way or the other so that it doesn't go under. And therefore, the emphasis, when you look at the operations in terms of the work plans and which activities take more budget as far as the operation is concerned. And I think this also applies to the deposit protection funds, or the insurance deposit protection funds, where we put more emphasis. Is it on guarding against failure, or it is on helping when failure has occurred? I think that's I thank you.
Thank you. I've seen another question crop up all the way from South Africa. So we will conclude with that one.
Thank you. It's not a comment, it's not a question, but rather a comment triggered by just the last speaker speaking as a regulator. That typically, we would say the role of the regulator is not to prevent failures, but when they do happen, they should be orderly. Because I mean, there's a tricky balancing act in terms of getting into the operations of those financial institutions. How far do you go? So the risk management of such institutions still remain with such institution, but as a regulator, typically you just want to make sure that you can prevent failures, but when they do happen, you just want them orderly and resolved as soon as possible. At least that is our stance from South Africa. Thank you.
Thank you. You can now proceed to answer those ones as we wind up our session.
Thank you. The first one was from Sobani, representative from Malawi. He had asked whether the crisis management frameworks, whether it is anchored within our law. I confirm yes, it is. Within the KDI Act, we are expected to undertake both crisis management and crisis preparedness. We are expected to participate in the resolution planning and the recovery planning, although that is the main job of the central bank, but we are expected to also monitor on that, because all that's built into what we do. As a resolution authority in Kenya, we are expected to actually prepare ourselves in the event of either failures, multiple or single failures of an institution, and whether they can cause a crisis or whether it's a small institution. But I can just mention that I've been with the central bank for more than 20 years, and we've seen some bank failures, and some of them might have been small, but they also have an effect on the people and the economy. It has an effect, whichever size it is. But of course, the systemic ones are much more, the effects are much more felt. But therefore, as part of our job, we need to prepare ourselves and have crisis management frameworks to be able to utilize them in cases of crisis. So it is anchored in our law. And whether you had also asked in the case of systemic situations, in Kenya, under the KDI Act, if in case there is a domestically systemic bank, the National Treasury, the CS National Treasury, and I mentioned, takes up on the same. Because as you are aware, we have a fund. We currently have about 250 billion. And some of these banks we cover, one of the big banks could have much more than that are covered. And therefore, we would not be expected as KGIC. And because of the systemic nature, by that failure. Therefore, they tend to be systemic in nature, and their contagion effects could be higher. And therefore, the responsibility by law is with the National Treasury. I hope I have answered that. There was a question on I think you had also mentioned something on the prompt corrective actions. I don't know, or it was somebody else. I will answer it on the second one. From Noella, you had asked, how do we prevent the overlap in roles? We usually have a chart, a timeline chart that shows the life of a bank. From the time it is licensed, we have them in color codes. When it is green, when it is operating well and everything is okay, that is within the ambit of the central bank. There is a situation when the bank is starting to have issues, and when it is amber, we call that the amber position. It is still within the central banks, and that is where they undertake the prompt corrective action. They look at ways of, asking them to inject more or to capitalize or to do all those measures. That is within the central bank. Now, there is a certain stage within the amber region where now we are expected to, the central bank is expected to involve the resolution authority. because now there is a likelihood of that bank now either coming to receivership or liquidation. And at that time, we are expected to work jointly with the central bank to look at ways of resolving this bank, whether through the mergers and acquisition, whether our fund as a deposit insurer on a least cost basis, we have to look at how much of that deposit in that bank, if it was to fail, how much will we be expected to pay out? If we find that the payout will be much higher than what we'd be expected to inject during a resolution of that bank, while it is still alive, while it is still operating, then we are able to undertake some resolution. So in that case, either through an acquisition or a transfer and exclusion resolution tool, then we are able to determine whether we are putting in money as KDIC to be able to ensure that there is a smooth transition of the depositors from this bank that is failing to this new acquiring bank. And therefore, some of that can be done without the public knowing. You only see a report that this bank has been bought by this bank, and things are smoothly undertaken. So that is where there shouldn't be an overlap. But in terms of mandate, we always say we are joined at the hip with the regulator, because we are the same 52 institutions are the same ones that are regulated and licensed by the central bank, and the same institutions are expected to give information. So there was also a question on data, whether we receive data. As I mentioned before, KDIC was a department of the central bank. The data we used to receive through the central bank main system, and therefore the same information that is given by the commercial banks and microfinance institutions on a monthly basis were being submitted to us as a DPF through the central bank. But as we moved into our own state corporation, we are able to get the information directly. We use the same electronic data warehouse to be able, we are connected to all the institutions, and therefore we are able to receive this data, either their balance sheet or anything, for us to be able to assess the profiles and profile this institution, and therefore and compare notes. So in case we are seeing an issue in one of the institutions, because of the MOUs that we have set up with the Central Bank of Kenya, we are able to compare, and ourselves as KDIC, we are the ones whose fund can be hit. When there is a bank failure, it is us who stand to lose, and therefore it is in our interest at all times to know the likely risks that we are likely to face, and therefore prevent them. And therefore we work closely with the central bank, and we have the MOUs in place to ensure that there is a free information sharing platform. And also we also have various fora, like the financial sector regulators fora, where we share information on various aspects of the financial stability of the country. And therefore, for me, I see that we do not have an issue. We might have personal differences, but in terms of work, we are all joined at the hip. We are supposed to ensure that there is financial stability in this country, and therefore no one should be able to cause a problem that can cause that instability that we are trying to minimize. I think I've answered on that. The representative from Uganda, you asked where should we put more effort. Yes, I agree. We should put more effort in preventing these bank failures, and we are trying to do that. But I think, as the representative from South Africa has mentioned, if a bank has to fail, it has to fail. When a bank has issues, either doesn't do good with practices, banking practices, for instance, it has to be closed. It doesn't matter whether it is that we should at all times have zero failures. But there are some banks that have to be closed in one way or another. And when they do, our job is to make sure that that is smooth, that transition is smooth, to minimize the disruption to the business community and the banking public. And therefore, it is true we put much of our efforts in our early interventions, and therefore try to ensure that we do all the resolution while the bank is still alive. But if in the unlikely events there are some that have to fail and they have to fail, then we manage how that resolution process is done in a smooth manner. I think that is where and of course now they mention on the representative from South Africa that you can't prevent failures. There are certain failures that can occur. Well, a bank can be closed because of malpractice. If they are not doing their business and it is endangering the depositors, the central bank can put that bank in statutory management or in liquidation. And it doesn't matter whether it is solvent or not, whether it is, and therefore we should be prepared. As part of our crisis management, we should be prepared not only on focusing on the orange or what we call the amber, but also even any of our banks can be a candidate for failure. And that is why in our crisis simulation, we try to even simulate instances of even banks that are very strong, because anything can happen. Any bank can fail, and it might not necessarily be because of solvency. It can be on any other matters. Or even with this information, the social media and all this, if it is so intense on an institution, it can actually cause a failure of that bank. And therefore, all measures should be put in place to ensure that this does not happen, and if they do happen, there is a smooth transition that really does not affect so much negatively on the depositor. Our job as KDIC is to protect the depositor. In all, whatever we are doing, we want to protect that depositor. Thank you very much.
Thank you very much. And immediately after that wonderful and elaborate presentation, we wish to invite back Bwana Sikuku. Please make your way to this place so that you can present this beautiful gift. As a PCF, we usually offer gifts. They are not small gifts, so we don't want to say something small. They are very serious gifts, but they are not within the taxable range, because I know as a public servant you may be asked to declare the same. So they are safe within the capacity whereby we are very humble but not humble. So this is from us to you, saying asante sana for the wonderful presentation, and saying thank you very much for keeping us through the conversation and making it a powerful ending to a great conference. We sincerely appreciate you and say asante, asante sana. Thank you so much. Thank you very much. Asante. Thank you. Thank you. One more round of applause for Madam Helen. Asante sana. We appreciate. Thank you so much. Asante. This one will be delivered into your car. If you prefer the office, we will still deliver it there. Even if you say we take it to your home somewhere in Eldoret, we will deliver. Thank you so much. I also recognize the presence of Bwana Eliud Adiedo, who is the CEO, Bank Assurance, not Bank Assurance, sorry, the Association of Insurance Brokers of Kenya, AIBK. Please say hi to us, Eliud. Asante sana, asante. You're my good friend, so I cannot ignore your presence anytime. Hata ningekupata huko kwa engineers, bado ningekuita tu. Now, we are on the final stretch of our session, because the people who are about to come here are to give the closing remarks, the vote of thanks, and some direction towards the evening, which I told you will be an evening like no other at the Carnival. The weather is perfect, the situation and condition is ambient, and yes, the energy is tops. We just await you with your African regalia. And remember, we are awarding the best dressed male and the best dressed female, so please be at the top of the game. And as that is also an opportunity for us to get a few photos like the ones we saw during the documentary in Masai Regalia. Now, these are the few announcements I'll make. Of course, our lunch will still be at the first floor where we had it yesterday. After the lunch, you're allowed to take your break, go spruce yourself, get some makeup. Let's have an evening That one will be done by Rosemary. Rosemary will tell us what is lined up on behalf of the committee. For now, I just want to confirm for the final time whether you remember the 4 things I told you we had come to do. Number 1, we had come to enjoy. Number 2, we had come to connect. Number 3, we had come to network. And number 4, we were here to celebrate. At enjoyment, we were giving the clap. At the connection, we were snapping. At the network, we were high-fiving. And at the celebration, we were clapping 3 times in quick succession. Let's try. Enjoy. Connect. Network. Celebrate. You're a wonderful audience. So let's try. I hope you've had a wonderful time as you enjoyed this conference and connected with people from various walks of life and formed a great network of people. Remember to celebrate such moments, because as you celebrate every moment that you get to enjoy, just connect with humanity and form great networks, because they say your network is your net worth. So most importantly, enjoy life. Connect with people in a personal way, enjoy every network you make, and celebrate life in all its possibilities. And remember to celebrate, and celebrate, and celebrate. That's how I got myself claps for being your MC. So, this moment, I want to invite before us Mr. Abudo Mamo for the closing remarks, and he will proceed to invite Madam Janet Kongo. This time I got your name right? Perfect. Corrected myself nicely. To give us the vote of thanks, and then I will be inviting Rosemary later to give us the directions. All right, so Mr. Abudo Mamo, a round of applause for him. Good. Oh, you want to do it from there? Oh, you want to do it from there? Okay. Okay, Sam. No, do it from here so that we have the man there.
Thank you. Small clap for Okari. I know we are on the final lap, winding up the conference part. And of course, on behalf of the policyholders, Madam Janet will speak on behalf of the chair and officially close. For me, on behalf of the managing trustee, whom I have said is away on bereavement, we want to thank the organizing committee, of course, led by Sir Zuma. Please raise your hand where you are. Zuma is there. We also want to thank many speakers: Askar, Alista, Afiza, I think she was on virtual, Katata, of course, Honorable Madam Helen, Omondi also. Somebody I've forgotten the name. The Kenbright guy, Masharia, and the panel, of course, moderated by one Moses. You've seen Moses? Moses, yes. He moderated, and of course we had Gondwe, Mlando, isn't it? Ruhato, then there is Itangi, I forgot one, Rocky. Then can you clap for them, please? On behalf of the managing trustee, we thank you. Merci beaucoup. Asante sana. Safe journey back home, including Kenyans. Tunawashukuru sana. I know the climax will be backed up by MC Okari. We have a lot of amusement. I'm really happy about what you did. Hope we'll make it better. So with those few remarks, I don't want to go into detail. I want to welcome Madam Janet on behalf of the chair of the board to give her closing remarks. Please clap for me. Thank you and have a very good afternoon.
receiving greetings with a smile. And I think that's why God gave me dimples, because I love smiling. I don't know whether I was supposed to walk in with a dance, with that music, but that is reserved for the evening. Okay, on behalf of the chair, the Board of Trustees, I take this opportunity to give vote of thanks on the inaugural African Insurance Resolution Conference. Ladies and gentlemen, as we draw the curtains on this landmark gathering, the inaugural African Insurance Resolution Conference and PCF at 20 anniversary celebration under the theme, Strengthening Insurance Sector, Resilience Beyond Failure, Resolution Policy and Practice, I rise with deep gratitude and humility to deliver the vote of thanks on behalf of our able chair, Honorable Simon Bogwa, Board of Trustees, and the Policy Holder Compensation Fund. First and foremost, we thank the Almighty God for giving us, through these significant days of dialogue, collaboration, and reflection. This conference has been more than just an event. It has been a convergence of ideas, a celebration of progress, and a call to action for building resilient insurance systems across our continent. To our chief guests, Honorable Simon Bogwa, we are truly honored by your presence and leadership. Your commitment in strengthening financial sector stability is a source of inspiration. Our heartfelt appreciation goes to all our distinguished speakers. I may get the name right, and if I don't get the name right, forgive me, because I come from the mountain. Askar, MD, I won't pronounce the second one because I know there's a problem there. The MD, JSC Insurance Payment Guarantee Fund, Kaskal, Mr. Campbell, President and CEO, Property and Casualty Insurance Compensation Corporation, Canada. In absentia, Ezekiel Masharia, CEO, Kenbreast Actuarial and Financial Services. In absentia, Mr. Elias Mondi, Principal Officer, FSD African. Our two virtual, the ones who joined us virtually, Ms. Afiza Abdallah, Executive Vice President, PIDM Malaysia, and our brother from Nigeria, Oga, Mr. Kabir Katata, Director Research and Policy, Nigeria Deposit Insurance Corporation, and our dear Mrs. Helen Chepkoni, CEO, Kenya Deposit Insurance Corporation, KDIC, for insightful, engaging presentation. I confirm, and I believe all the delegates here will confirm, will associate with my statement that I'm about to say. I confirm the topics were illuminating and have provided valuable insight. Is that not true? To our panelists, I'll start with my co-lady who loves smiling, Ms. Malundu, Division Head, Enforcement and Resolution, South Africa, Reserve Bank, Dr. Sopani, Director, Finance Sector Regulation, Department, Reserve Bank of Malawi, Mr. Ruhato, Principal Inspector, National Bank from Rwanda, Mr. Alex Rocky, Manager, Actuarial and Statistic, Tanzania Insurance Regulatory Authority. Last but not the least, Mr. Bernard Gitangi, Manager, Supervision Insurance Regulatory Authority, Kenya. I confirm your expertise and conduct have enriched our conversation and challenged us to think boldly and act decisively in addressing insurance resolution and policyholder protection. To all our delegates from across the continent, including Rwanda, South Africa, Tanzania, Malawi, Uganda, and within Kenya, thank you for showing up, engaging meaningfully, and making this inaugural event a resounding success. Not forgetting our MC, Mr. Okar. As much as you told us to thank you by giving you some few applause, I want to thank you for making this event lively. Do you agree with me? We salute you. Last but not the least, in a special way, and if I don't say this, I know there are people who are going to report me, but let it go on record. In a special way, we wish to extend our gratitude and thanks to Dr. Kajwang, MBS, who is also the board member at PCF, for hosting us at this state-of-the-art, world-class convention center, one of its kind in the region, the Hage Convention Center. And I encourage all of you, both Kenyans and our brothers and sisters from the continent, you bring your meetings and convention to this magnificent venue. Are you agreeing with me? So can it go on record that you'll honor these requests? As we part ways, may the insight, gain, and connection made here drive real transition in our respective jurisdiction. Finally, we are especially grateful to the organizing team, Zuma, Moses, and the rest, support staff, service providers who have worked tirelessly behind to bring this vision to life. Your dedication ensured that every detail of this conference reflected excellence. Let us remain united in our mission to protect policyholders, strengthen market confidence, and shape a more secure and inclusive future for insurance in Africa. To our international delegates, do not forget to tour our magical Kenya. Just as you were told, the park is just across here, the great Kenyan hospitality. And make sure you tour our national park in the city. Thank you, and I wish you a safe journey. I've been given this noble opportunity to close this session, but this is not the end. I think we'll officially close the session in the evening. So just count yourself that the function is not yet over. Looking forward to see all of you at Carnival in your best African attire. Thank you very much, and God bless you.
Thank you so much, Madam Janet. You have such a gracious voice that reminds me of how my African mother would handle me whenever we had guests around. I don't know whether they went to the same school, but when we were misbehaving, when the guests were around, your mom will come and say, "My son, you look so smart and handsome. You see the bread you want to take for the guests? Don't worry, there is a lot in the kitchen. Please come and enjoy it in the kitchen." And then when you enter the kitchen, life will change automatically. And then she tells you, "My son, now pass in front of the guests on your way out while smiling. And let me not see tears." Oh, our African mothers. And here we are, such a gracious voice. Another round of applause for Janet. Thank you so much. And yes, we agree with the dimples aspect. It is one of those things that make life straight with a curve of a smile. Thank you. Now, we are headed to the remarks about what is up for the evening. I may not have the very best term to describe it because one of the members of the organizing committee, and of course, the Deputy Director, Corporate Communications, is better placed to corporately communicate this to us. How will the evening be? A round of applause for Rosemary.
Good afternoon once again.
Good afternoon. I know you are tired, but I'll be very brief because, of course, according to protocol, when your bosses talk, you're not supposed to talk. But I've been given 1 minute to do that. Maybe before I just give you the next phase, I want us we appreciate our able MC who has been here for 2 days and conducted everything professionally. And I want us, I want us, we give him factorial claps. You know factorial claps? We'll do 5 of them. We do 1, 2, 3, 4, 5. 1, 2, 3, 4. 1, 2, 3. 1, 2, 1. Are we together? Let's warm our hands. This is for our MC or Kari. Then let's go. Thank you so much. As I've said, I'll be very, very brief because everything has been said. This evening, we are going to the next phase. Immediately after this, we are heading for our lunch, which is served on the first floor, just where we had yesterday. After that, we will give you a few hours to go and refreshen yourself, because now the evening will be hotter than it has been in the conference. So, what am I saying? The venue will be at the Carnival restaurant that is in Langata, that side of Langata, and it is known for its experience. That is the Beast of Feast, offering the variety of meat roasted to perfection. So please, the prayer. And before the prayer, I'm being reminded we have our national anthem as well as the East Africa national anthem. So let's be upstanding. Then after that, Doreen will come in for the closing prayer. Thank you so much, each and everybody, and God bless you.
Afrika Mashariki, tuwezeshe kuishi kwa amani, tutimize na malengo yetu. Jumuiya yetu sote tulilinde, tuajibike, tuimarike, umoja wetu ni nguzo yetu, idumu jumuiya yetu.
Good afternoon. Let us pray. Dear Lord, we thank you for the successful conference we've had. Thank you, God, even for the knowledge shared and experiences. We pray, God, even that we go back to our respective institutions, that we will implement what we've learned and share together. I pray also, God, even for journey mercies, for people traveling back home. And I pray, God, even for this evening that we'll have our gala dinner. I pray that your presence will be upon us. And even tomorrow's excursion, Lord, I pray that your presence will be upon us as we explore Nairobi National Park. In Jesus' name I pray, even for the meal that we are going to take. Bless it and let it nourish our bodies. In Jesus' name I pray and believe. Amen.